The economy is bruised, but not yet really battered.
This is a labor market that's very unlike any that we've seen before.
It's really challenging at this juncture to get a really good sense of the labor market.
There really is very little evidence that the labor market's falling apart at this point.
The underbelly of labor, I think, is softer than most people appreciate.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Coming into Friday, following a series of skirmishes, the White House playing down a military clash with Iran. As the president's latest 10% tariff is facing a legal setback, investors are waiting for data, gearing up for the latest jobs report. Payrolls just around the corner.
Just to put this into perspective, we're poised for the first back-to-back positive jobs numbers that we've gotten since May of last year. That's how varied we've seen some of these numbers coming in, and potentially we could be seeing a pretty strong report. Here's the rub. Is this going to be a good thing? Well, absolutely. This has been what's been supporting risk assets, the idea that U.S. momentum can continue. But what does this mean for the bond complex, given the fact that we're creeping up against 5% for 30-year yields, and it really constrains the Fed?
Small signs of a consumer slowdown as well across a number of companies. Kraft, McDonald's, Dime Brand, Shake Shack got absolutely hammered. Their unwillingness to pass on higher costs. That's notable in the last 24 hours.
So this contrasts with Uber, with DoorDash, and some of the other consumer-facing brands that have had different types of results. Is this an execution problem? Is this an excuse? Or is this the K-shaped economy rearing its head? The companies that cater more to people in lower income brackets are not able to pass along those costs, are seeing declines in terms of purchases, while other people, particularly those who cater to people who have the wealth effect, are able to raise prices. That's what we're seeing. When does it start bleeding into some of the averages that we're seeing?
I'm right there with you, and the averages is where we should focus this morning. You'd expect the payrolls report today to capture the resilience of the headline level. You'd expect at the corporate level to capture some of the disparity beneath that headline. Markets going to be anchored by the former, not the latter, until you start to see those problems migrate into other income groups that starts to really hit the average.
That's the reason why the composition of the jobs are going to be really important. Do we see lower wage healthcare types of jobs that are pretty cycle independent, or do we start to see a broadening in that as well as higher wages? Also, it has an implication for the political sphere and what types of regulation or constraints there might be on this.
The price of this will influence the politics as well. Check it out. Brent and WTI slightly elevated today. Not a big move. We're higher by 0.4% on Brent crude at $100 and about 50 cents. Think about the week we've had. Skirmishes on Monday, skirmishes on Thursday, the seizure of a tanker, that headline just crossed in the Bloomberg just moments ago, and crude on the week is down by 6 to 7%. That's interesting.
Because verbally, the ceasefire still holds, which gives the signal to the market that this administration wants to see an off-ramp when it comes to the conflict in Iran. What we had overnight, U.S. Central Command called it does not want to seek escalation from it, but they did fire back on Iran because the country, Iran, fired on 3 Navy destroyers. The president called it a trifle, and then he told ABC News it's a love tap. Maybe just a reminder, if you hit us, we're going to hit you back. But at the moment, they want to keep this ceasefire in place.
Would you like to translate what a love tap is?
That's not my love language.
No.
That's all I can say. I don't really like missiles.
I don't think you're alone, Bramo. I don't think you're alone. The latest headlines on a conflict in the Middle East. Equity futures right now in the S&P 500 positive by 0.4%. Coming up this hour, Chris Verrone of Strategas with equities bouncing back. And Wald of the Atlantic Council following fresh strikes between the US and Iran. And Stephanie Roth of Wolfe Research looking ahead to the payrolls report. We begin this hour with stocks heading for 6 weeks of gains. Chris Verrone of Strategas, a bad company, writing, this is a market that is short-term overbought, but we view that more of a feature than a bug. Consolidations should still be bought. Chris joins us now for more. Chris, good morning.
Good morning. Great to be here.
Good to see you. Good to see you. I can't think of a time where we've heard the comparisons to 99 as much as we have this week. How many people have come up to you and said, Chris, is it 1999? Is this the tech.com bubble?
It's been constant. We've been on the road all week. It's the topic of every meeting. And listen, I get it. When you look at some of these comparisons, particularly in the chip space, I mean, the semis are up 150% over the last 12 months. I mean, that would be a record were it not for 1999 when they were up 250% over a 12-month period. So you're kind of in that stratosphere where you don't know the hour or the moment. But I think if we're sitting here a year from now, we're having a different conversation. If we're sitting here 6 weeks from now, I don't know if we are having a different conversation yet. It's that difficulty with, these parabolic type moves. Parabolic charts ultimately won't correct quietly. They will correct violently, but when that comes is anyone's guess. I would be looking over my shoulder here just a little bit, particularly on the semi stuff. But when I look at the broader tape here, I think what's a little unappreciated is things like credit conditions are still pretty benign. We talked about oil actually lower this week on what felt like some pretty nasty headlines. So I think the market's generally okay.
Let's take the oil move.
Yeah.
Down on the week by some 7%. That's a moving target at the moment. One more day to go. Two-year yields in the face of that have stayed pretty level, elevated through the week. What does that tell you at the moment?
Yeah, I think the two-year yield here is, frankly, maybe the most important part of the call going forward. I mean, twos are now, call it 15, 20 bips above Fed funds. First time we've been above Fed funds on the market rate since, I believe, middle of 2021. So if we're thinking about, what does a Warsh Fed start to inherit here over the next number of weeks, an environment that, frankly, isn't too enviable, that you have the market rate above the policy rate. Now, I don't think two-year yields are really going to get away from us big here. I could see them maybe going to call it 4.25 would kind of be the upper end of the line here. But I think if you're looking what could be the test of a new Warsh Fed, in the first 6 months as new Fed chairs tend to be tested, it's two-year yields getting away from the policy rate, it's commodities continuing to go, it's all the things, and we'll see with labor today, but perhaps weak jobs. So that's a very tricky combination for a new Fed chair.
I'd love to pair these two ideas.
Yeah.
The idea of the incredible rally in tech and the resilience that we're seeing in the economy. How much is the rally in big tech, the concentration of some of the gains, masking some of the weakness elsewhere versus supporting strength, right? Which side of the equation does it fall in?
Well, I think if you're expecting or anticipating that the consumer, for example, is going to suddenly take up the baton of this economic boom and be the next story, I think you're going to be underwhelmed. This has not been a consumer cycle. It hasn't been a consumer cycle, frankly, since COVID. Consumer discretionary has not made new relative highs versus the S&P since 2021. I mean, for the last 5 years, this has been a CapEx production cycle, not a consumer one. So I think the mistake here would be looking at the Shake Shack results from last night, or I think the discretionary sector made new relative lows actually versus S&P yesterday. I think the mistake would be saying, oh, that's a warning sign about the economy. No, that's been a constant for 4 or 5 years now. This is a production, CapEx, industrial-driven cycle, not a consumer one.
Is there anything you could see in today's jobs report that would change your mind, that would make you think that maybe we're on the brink of seeing some kind of re-acceleration in the consumer sector?
Well, listen, I think the mistake would be pretending that the labor picture is terrible here. I mean, what were claims? I think claims last week were 185,000. I mean, that's like a 60-year low, right?
Yeah.
One of the stories, frankly, your magazine this week was jobless. It was educated and jobless, right? The picture of all the young kids. Well, the youth unemployment rate, 20 to 24-year-olds, just went from 9 to 6. So the data doesn't support the narrative that's out there. Software job openings are up, not down. So I think we got to just do a little bit digging and say, does the narrative actually get supported by the data? I think the data is a bit more resilient than people would expect, especially on the labor front.
So when it comes to the Fed meeting, when you talk about data like this, where does this leave Kevin Warsh when he enters the room?
It seems like there's some avenue to hold. I think hold's acceptable here.
Acceptable to who?
I think when you look at some of the remarks out of Treasury over the last few weeks, there's an avenue here or some room or some cover to be on hold for the next couple months. I think the real key, Annmarie, is when we think about where twos are versus the policy rate. We do not want to get into this mid-2021, early 22 environment where you have twos gapping away from Fed funds. That is the message. Wait a second, something here has changed in a big way. In a lot of respects, put this in context of gold for a moment. For 3 or 4 years, we hear all these elegant reasons of why gold is up, right? De-dollarization, it's a geopolitical hedge, all the central bank buying. Maybe it was as simple as two-year yields were falling for 3 years. And now that two-year yields have stopped falling, what has happened? Gold's been completely indifferent. I think sometimes in this business, we always strive for this, very intellectual narrative when it's just as simple as what are short rates doing? Short rates were falling, gold went up, short rates have stopped going down, gold seems to be struggling.
The opportunity cost has shifted.
Yeah.
Clearly, it's a different story right now. It's amazing we just had a long conversation with you about financial markets and have not talked about Iran. Barely touched the issue at all. Is that the same as your conversations on the road at the moment?
You know, Lisa, last time we were here, we were talking about the less you know, right?
Use that all day.
Right?
I absolutely love that.
Used it earlier this week.
I embrace that at home, and my kids do too right now.
I go back to February 27th, right? The night before the bombs started flying. If you knew what the headlines were going to be over the next 12 weeks, I think you'd be very bewildered about where the market is. I think in periods like this, you always want to be on guard for what is kind of defying your intuition or acting differently than you would suspect. And I mean, defense stocks have absolutely been awful throughout. I mean, look at Rheinmetall in Germany this morning, breaking down this morning.
Yep.
We mentioned gold from that perspective as well. So we're all simple one-dimensional thinkers. The market's a third-dimensional thinker. It is several steps ahead. And I just want to make sure I have an imagination to consider, hey, what is the market actually telling us? As unfathomable as it may sound, is this Middle East conflict maybe a message that we're kind of moving past a lot of the geopolitical dynamics that have dominated the last 4 or 5 years? That seems so improbable, but I also know improbable stuff happens in this business all the time.
Reinforced by the price action. I often go back to February 27th and look at the price of Exxon. Not a perfect tell on anything, but a tell. 152.50 at the close that day. 146.58 at the close yesterday.
Talking about third-dimensional chess or 10-dimensional chess in terms of the markets, are people gaming out the idea that they're probably not going to invest, they're going to have damages, they're going to be constrained, or maybe investors are pushing back at any kind of extra capex? They've been rewarded for actually reducing capex. I mean, all of these things in terms of three-dimensionality.
Or maybe we learned that the Strait isn't as important as everyone thought. You know, I think one of the most remarkable things in kind of the face of this war, we were all told Japanese equities can't work in this environment, right? They're so dependent on Middle East oil, big energy shock in Japan. I mean, the Nikkei is up 25% off the lows. It has been, without question, among the more remarkable stories, I think, over the last 8 or 12 weeks.
Chris, it's good to see you.
Good to see
Thanks
you.
for breaking it down. Thank you, buddy. Chris Verrone there of Strategas on this payrolls Friday. The number drops at 8:30 Eastern Time. The estimate in our survey, 65K. We'll have more on that jobs report later in the programme. Let's give you an update on stories worldwide this morning with your Bloomberg brief. Yahara Ahmed has more. Hey, Yahara.
Hi, John. Tensions escalating between the U.S. and Iran. The U.S. attacking military assets it says were used to attack its warships in the Strait of Hormuz. President Trump threatening to hit Iran even harder if a peace deal is not reached. A federal trade court declaring President Trump's 10% global tariffs unlawful. The panel granting a request by a group of small businesses and some states to vacate the levies. It comes just months after the Supreme Court struck down Trump's other tariffs under emergency powers. This time, the court finding the administration misused a different trade law. And President Trump's giving the EU until July 4th to ratify its trade agreement with the U.S. Washington had previously threatened to hike tariffs on auto imports as soon as this week if it failed to make a deal. That's your Bloomberg brief. John.
Yahara, thank you. More from Yahara later this hour. Up next on the programme, fighting for peace.
They trifled with us today. We blew them away. You won't have to know. If there's no ceasefire, you're not going to have to know. You're just going to have to look at one big glow coming out of Iran. And they better sign their agreement fast.
Up next, we'll catch up with Ahmed Helal of the Asia Group, live from New York City this morning. Good morning. The jobs report just around the corner, dropping at 8:30 Eastern Time. Here are the guesses from the big banks for you. I'll tell you the median. The median is 65K. The 3-month average just short of 70K. Looking for things to stabilise a little bit later this morning, allowing this Federal Reserve to focus much more on the other side of the mandate. And it seems this Federal Reserve is a lot more focused on the other side of the mandate right now.
We heard from a number of Fed presidents yesterday. We heard from Boston Fed President Susan Collins saying that she agreed with the hawkish dissenters. Cleveland Fed President Beth Hammack saying that interest rates are going to be on hold for quite a while. Minneapolis President Neil Kashkari, he has been relatively hawkish through all this, saying if the Strait of Hormuz is closed for an extended period of time, it may well be that the next move might need to be up. in interest rates. And you're starting to see that priced into markets.
He's no longer running for Fed chair. Is that the take?
I think that strait has closed.
That strait has closed a long time ago. Futures right now, the S&P 500, brutal stuff. Up by 0.4% on the S&P. On the Nasdaq, up by 0.6%. In the bond market, two-year yields have stayed elevated through this week, around 390. We're down 2 basis points. Yes, we're off the highs, 2s, 10s, 30s. But still, as Chris Verrone was talking about, above the policy rate, the Federal Reserve, even with this move in crude, down by some 7% on the week so far. That just tells you where we're at right now with this Federal Reserve. Crude, by the way, not making a big move this morning either.
Fed funds futures increasingly pricing in the chance of a hike by next year. Stephanie Roth, who's coming on later this morning of Wolfe Research, said that about half the move in 10-year treasuries is attributed to the move in crude. About half of it's just the underlying strength of the economy. So there are two prongs, two aspects to the rise in yields that we've seen. And we might get another sort of read on that later this morning.
Looking forward to that exchange with her later this hour. Under surveillance this morning, fighting for peace.
They trifled with us today. We blew them away. They trifled. I call that a trifle. I'll let you know when there's no ceasefire. You won't have to know. If there's no ceasefire, you're not going to have to know. You're just going to have to look at one big glow coming out of Iran. And they better sign their agreement fast. Let's see if they are willing to sign it.
So here's the latest this morning. The US and Iran trading fresh strikes in the Gulf, with President Trump ramping up pressure on Iran to make a deal to end the war. Bloomberg's Tyler Kendall joins us now from Washington for more. Good morning, Tyler.
Hey, John, good morning. Well, President Trump says that the ceasefire is still fully in place, at least as of now, even as he renews threats to resume military operations if Iran doesn't come to the table. Now, this latest flare-up in fighting that we saw yesterday was, of course, centered on the Strait of Hormuz, as Iranian state media confirms that the country's military did target 3 U.S. naval destroyers, partly in a bid for retaliation for the U.S. disabling an Iranian-flagged oil tanker earlier this week. In response, the U.S. targeted Iranian military assets, including missile and drone launch sites overnight. CENTCOM confirmed that no U.S. assets ended up being hit by Iran during this clash, but it does underscore how Iran is trying to tighten its grip over the waterway, as new headlines crossed the terminal right before the start of this program this morning that Iran has seized another oil tanker in the strait, according to Iranian state TV. All of this is threatening to derail any potential progress when it comes to talks, as Bloomberg News reports that the White House could potentially see a response from Iran as soon as today to that latest proposal, that one-page memorandum of understanding that may see a gradual reopening of the Strait of Hormuz, with the U.S. lifting its naval blockade. But new from the Wall Street Journal overnight, it appears that the Trump administration is making preparations to resume its mission to guide vessels through the Strait of Hormuz with or without a deal. Now, John, President Trump is still trying to strike that optimistic tone. He told reporters just yesterday that a deal could, quote, happen any day now, as we know that he is feeling the pressure to try to get some agreement done before he heads to China next week. Our analysts at Bloomberg Economics do say the fact that he is still planning to go overseas does lower the risk that we would see an uptick of fighting while he is abroad.
Tyler Kendall with the latest. Tyler, thank you. Down in Washington, D.C. Let's extend the conversation. Ahmed Helal of the Asia Group writing, both countries want to avoid a return to war, so the state of limbo in Hormuz can just rumble on for months. Ahmed joins us now for more. Ahmed, welcome to the programme. My good friend Guy Johnson said this in London earlier on this morning. I think it's important, the difference between intensity and persistency. It looks like the administration is committed to dialing down the intensity of this particular conflict. When does persistency become a much bigger issue, though?
Well, I think it's not about duration. It's about a war of wills here and who's going to blink first. Both countries have a blockade on Hormuz, but the difference between both countries is that the U.S. doesn't have a strategy. It doesn't have a political objective. Iran has a very clear strategy. It has extreme clarity on what it's trying to do. It triumphs by surviving. The U.S. first says it went into this war to ensure that Iran doesn't have a nuclear weapon. At one point, it was regime change. But the fact of the matter is that the U.S. is very eager to walk away, to find an off-ramp, because it has many theaters that it has to worry about. The U.S. president is going to China in less than 1 week. There's Europe and Russia, Ukraine. It's a superpower. It has many distractions around the world, whereas Iran is a one-issue country right now. It is concerned only with the survival of the regime, with the survival of the Iranian state, and ensuring that it has a path to reopening the Hormuz Strait eventually, but not without ceding leverage over the United States.
Well, Iran also wants to make sure they can get their oil out. The economy is in a dire strait right now. At that point, do you see them being willing to potentially allow some flows to go in and out of the Strait of Hormuz? How long would it take? How long could they hang on to where things are right now?
The fact of the matter is they've actually been able to. They've been able to through their shadow fleets and through slipping through the U.S. Line, the U.S. blockade. They've obviously their shipments outside of the strait have fallen to a trickle, so their revenues have fallen significantly. But they have prepared for this point in terms of essentials and being able to supply their population with food and medicine and drawing down the reserves. They've been able to do that. They've been stockpiling. We know that prior to this war, when they saw the assets of the U.S. converging on this theater, they were stockpiling for food and medicine and preparing for this moment. And don't forget, they've been under the sanctions for a very long time, and they have time because Iran is going nowhere. Iran can afford to have strategic patience. It is a permanent part of the geography of the region. It's been there forever, and it is not going to disappear anytime soon. Where the U.S. does need to retreat from this because it's costing taxpayers $25 billion and counting.
When it comes to Iran's willingness to hang on to this, Ahmed, at some point, though, will the global community's pressure be enough to potentially lift some of this?
I think China can bring some pressure to bear. The Arab states certainly don't have any leverage over Iran. I think it's very hard to see them ceding leverage over the strait without some serious concessions, including a pact for non-aggression in the future. This for them is a nuclear weapon without acquiring a nuclear weapon. This is actually more potent than a nuclear weapon because you can't really use an atomic bomb. You can't use a nuclear weapon, whereas you can use the Strait of Hormuz quite inexpensively to bring the Arab states to a fiscal halt and bring the global economy as a hostage to Iran. So I don't really see them ceding that leverage anytime soon. They can afford to have this rumble on for a few months.
Ahmed, could you explain what happened with Saudi Arabia and the United States over Project Freedom that was part of the reason why that was put on hold? And there's been some disagreement about using airspace. What's the main objection from Saudi Arabia?
Fear of retaliation. They were worried, like the UAE, which has borne the brunt of the retaliation of Iran. They didn't want to have their airspace and their bases used to confront Iran and to fight the small boats, the vessels that are attacking vessels trying to transit the straits. So the Saudis said no, and then Trump did a remarkable U-turn after 36 hours or something, which is a function of erratic U.S. policy making from the outset, because they simply don't have a political strategy. And Trump is really struggling to find a dignified way to exit this theater.
Ahmed, appreciate your take and your perspective. Ahmed Helal there of the Asia Group on the situation in the Middle East. The impressive thing about this week, the headline so far, things can of course change going into the weekend, is that the ceasefire is actually held, that they're committed to the so-called ceasefire. Despite this skirmish we've seen this week, not once, but twice, and the seizure of a tanker in the last 30 minutes or so.
You know, ceasefire is very good branding. Maybe we should just rebrand this as not escalation, at least not meaningful escalation that ends up in some sort of spiral in the way that we were seeing earlier. Nonetheless, you are correct, and that is a signal that markets are taking, that both sides are not looking for reasons to escalate. In fact, they're looking for off-ramps. That's the main message this week.
They've had plenty of opportunities to resume hostilities.
Correct.
And they haven't taken those opportunities. And that's what the market at the moment is committed to, this idea that we're on a path to de-escalation. Could be a volatile one, but we're still on that path.
Which is a reason why you're seeing oil prices where they are, because otherwise they'd be a whole lot higher.
Futures this morning up by 0.5% on the S&P. Up next, we'll catch up with Ellen Wald of the Atlantic Council with crude rising, plus Yahira's back. She's got your morning movers. Cloudflare cutting jobs in a new bet on AI. The stock market, look at this, it's down 17% in the pre-market. These are your scores this morning. Bouncing back by 0.5 on the S&P, on the Nasdaq up by 0.6 to 0.7% higher on the Russell this morning, pushing higher by 0.4%, on course for a sixth consecutive weekly gain on the S&P and the Nasdaq 100, the longest weekly winning streak going back to October 2024. Supported by this as well, this move in crude on the week so far down by around 7%. Crude at the moment, Brent and WTI. Brent crude just about unchanged, around $100 a barrel. WTI around 94, down 0.1%. What's intriguing about the move in crude right now and through the week is that we haven't advanced in quite the way you'd expect, given the skirmishes we have seen on the ground in the Middle East. And that hasn't blended and folded into this move in the bond market. The two-year yields have stayed elevated on the week, I think is interesting. 2s, 10s, 30s. 2s at the moment down by 2 basis points. The 2-year at 3.8929, above the policy rate of the Federal Reserve. Lots of pushback from the Fed about the easing bias, and more company than maybe we thought than just the 3 dissenters against the language in that statement last week.
Yeah, and that really was evidenced by Boston Fed President Susan Collins coming out and saying even though she wasn't a voter, she would have agreed in terms of removing the easing bias in the language going forward. A key question is why this Federal Reserve is treating this so differently than, say, the tariff-related price shock. This feels different, and this is because the strength in the underlying economy is allowing some of this inflation to push through the economy.
Yields this morning down just 2 basis points, 10s at 436. 3 hours away from the opening bell. Let's get you some morning movers, some single names. Yahara has more. Hey, Yahara.
Hi, John. This is the first earnings report from Block since it announced those AI-driven job cuts, and it appears they are paying off. Shares are up 6.7% after the company delivered a beat and a raise, with Block saying that AI is helping it cut costs, speed up software development, and improve its payments apps. Turning to another company also announcing AI-driven job cuts on this jobs day, that is Cloudflare, saying that it is slashing about 20% of its workforce. But unlike Block, the market is having a different reaction. Shares are falling 17.8% as investors appear more focused on the slowing growth story after its revenue slightly missed. So it's raising questions about whether AI is really the driver here. But the CEO did mention a few new efficiencies due to that. And we end on shares of CoreWeave. They are also falling in the pre-market, down 6.4% after the NeoCloud delivered a disappointing forecast as losses continue to mount. The company is racing to build out more AI data center capacity, but investors appear concerned that the costs are piling up faster than the payoff. John.
Yahara, thank you. More from Yahara later this hour. On our radar this morning, President Donald Trump saying the truce with Iran is still in place after the two nations exchanged fire near the Strait of Hormuz. The White House awaiting Tehran's response to its proposal to reopen the strait and end the conflict. Elsewhere, a federal trade court declaring the president's 10% global tariffs illegal. The limited ruling only applies to the two companies that filed the suit and Washington state. It's not yet clear what the decision means for other importers already paying the levies. And finally, check this one out. SoftBank scaling back plans for a $10 billion margin loan backed by its OpenAI stake. The company could revise the target to an amount as low as $6 billion, the move coming after hesitation from some creditors.
This indicates that there is some speculation about what OpenAI's actual valuation is, right? As they head toward that IPO and as they deal with some setbacks, especially tied to losing share to Gemini and Anthropic's Claude, a question about what the valuation actually is and whether it's been a little overly elevated in some of the recent funding rounds. This indicates that creditors are pushing back on the valuation that SoftBank had assigned to it. This is going to be a problem for the likes of SoftBank, which are more heavily invested in some of these names, but also raises questions about how this IPO really will go.
Right, and it raises questions about, was all the information we've been hearing in terms of how sky high the valuation is going to be, was that just some of it hype before this IPO? And I think you're going to see potentially a lot more headlines like this as we go towards the summer.
The Anthropic effect. That's what it feels like right now, the Anthropic effect, that maybe there's a winner-takes-all mentality to certain players in private markets right now.
Certainly the tides have turned against OpenAI, at least in the rhetoric, and even the idea of what Elon Musk was saying, in terms of throwing shade at Sam Altman, talking about, well, at least I didn't feel evil, when he was talking with the Anthropic folks with the SpaceX discussions. Nonetheless, there is some concern that they aren't getting the same kind of bookings that they were getting before, even though they're saying that their bookings are sky high. The lack of clarity, I think that's been one feature of this market this year. The more opacity there is, the more skepticism there is in markets, the more any kind of rumor can lead to outsized moves. We saw this in private credit, and we saw this with some of these private companies that haven't yet gone public.
What's Chris's line? The less you know.
I love that line.
The less you know.
I mean, again, that's probably problematic for our industry.
Might apply to this as well. Let's talk about crude climbing after fresh strikes between the US and Iran near the Strait. Wald of the Atlantic Council writing the market is going on headlines and not on the situation on the ground. Crude prices should be higher, especially given how fast stocks are being depleted. Ellen joins us now for more. Ellen, can you just build on that a little bit and be slightly more specific? When you say crude prices, are you talking about physical markets or the paper market?
I'm talking about the paper market should be higher given the incredible rate at which stocks are being depleted. I mean, we've seen incredible big draws from U.S. stocks, and other countries are also depleting their stocks of oil. Now, we're continuing, obviously, to produce more oil, so it's not like Americans should suddenly, get up in arms and rush to think that we're going to head into an oil shortage. But this is a situation in which, we're depleting what we have stored. And so pretty soon things are going to, should become more expensive. And yet what we're seeing in the paper markets is that the price is not reflecting this. And that's having some really intense reverberations, I think, around the economy, but also in the oil industry in the United States. We are only hearing right now from some producers in the United States that they plan to even increase production, whereas this conflict's been going on for over 2 months now, and the price indicators should have already been there.
So, Ellen, just to build on that, because a slightly interesting dynamic is starting to emerge, that we've seen physical prices come down because of the inventory drawdown. And I'm just wondering if you expect the paper market to start trading above where physical is in anticipation of just how unsustainable this drawdown is.
I think that's absolutely a possibility, but I think, again, the paper market is so determined by a headline or a tweet or, what people imagine is going to happen, when the reality is not just what's happening physically with oil, but also what's happening with the actual state of affairs between Iran and the United States. They're making it look as though an end to this conflict is, just, one 14-point paper away, when that's not true at all. Even if there is, an agreement on something, which, by the way, there hasn't actually been an agreement on anything other than this ceasefire, which, during the so-called ceasefire, we've seen major damage to some UAE facilities. So it's really, I think, what we're operating on, or what people are trading on in the markets, is not necessarily what's happening on the ground in the military situation, nor is it what's happening on the ground in the physical situation with crude oil.
But to John's point, I'm looking at Dubai crude right now. It's under $100 a barrel. Isn't that astonishing, given everything you've just laid out?
It is astonishing, but also, who's going to buy Dubai crude? How much of it is actually available? So, how can you actually get it? Can you actually get it? Is there any guarantee that you could get it in 2 months or in 3 months? So I think that there's definitely a major disconnect going on here. And I think that it's hurting the ability of producers that can produce more to justify putting that production into play. And I think that if we were receiving information about the situation, which is more accurate, that companies and oil companies and traders would be able to take positions that would more accurately reflect that. And I think we'd all potentially be better off.
How acute is the spike higher going to be if and when we are still in this situation and the global supplies and inventories are completely drawn down?
I think the spike will be very significant if we're still in this situation and, we're just operating off of whatever is being produced as opposed to what's in storage. Although I do think that there's probably more in storage than we necessarily have an accounting for. So there's China. China, we're talking about how China hasn't even touched its SPR. Remember, what China considers its SPR could be kind of more similar to what we might consider our oil stocks. So there's definitely more room there. Of course, China's not a reliable player necessarily in the global marketplace in terms of a source of oil. So you can't necessarily say, yes, China will access this at this point. That's more of a political decision than it is an economic one.
Ellen, I'd love your take on a debate we were having earlier this morning with Chris Verrone. John mentioned that oil stocks, the oil majors, Exxon, Chevron, et cetera, have underperformed. We're seeing actually prices go down quite significantly. And what is the signal from that? And we were speculating maybe it was already brought forward in terms of the gains. And what Chris Verrone said is maybe it's telling us the Strait of Hormuz just really isn't that important. What's your take on why we're seeing some of these prices of the shares of oil majors actually underperform over the past month or two?
Yeah, it's very interesting. I've been following that too and kind of wondering the same thing. I think not necessarily that the Strait of Hormuz isn't as important as we think it is. I think it's perhaps not as important the same way we might have thought it was in the 1970s. One of the things that we haven't always necessarily considered is we've made incredible gains in terms of energy efficiency since the oil shocks in 1973. We've made incredible gains in terms of production and storage capacity and refining. And so I do think that it's perhaps, I don't want to downplay the significance of oil in general, but it could potentially be more an example of, it's reacting more to what's happening in the general stock market, or it could be an example of the fact that these companies are not necessarily, trading along with how we're trading this conflict. And I do think that that's something to consider, and it's a very interesting observation that they're not necessarily following along with this. But there's more to Exxon and Chevron than what's going on in the Persian Gulf.
Ellen, it's good to see you. Thank you. Ellen Wald there of the Atlantic Council on the oil market right now. What have we underestimated? If anything, what have we underestimated? I think perhaps one. There are many more, but one. Just how powerful the inventory drawdown has been over the last 2 months. I think some people in the oil market thought it would just be a drip feed and wouldn't make much of a difference. It's clearly made a massive difference.
The other thing that we've underestimated, Ajay Rajadaksha of Barclays was talking about this, how oversupplied the market was ahead of this conflict. And we had talked about why prices were so low, given how much oil there was sloshing around. He said that this conflict really only began about 5 weeks ago, not 8 weeks ago, because that was when some of that excess oil started to get used. That's a really interesting perspective.
Ellen also brought up a really good point that could come up in the meetings next week between Trump and Xi Jinping. China has massive reserves, 1.4 billion barrels in reserves. And if they wanted to help this market, they could release that. They haven't yet, but they could. And that could be an ask from this administration.
Out of everybody, China prepared for this war better than most, and they're not even in this conflict directly. Brent crude right now, $100 a barrel. Let's keep an update on stories elsewhere this morning with your Bloomberg brief. Yahara has more. Hey, Yahara.
Hi, John. The Iranian army seizing an oil tanker, the semi-official Tasnim news agency saying the tanker attempted to disrupt Iranian oil exports. The agency publishing a video appearing to show at least 2 small boats approaching a ship and armed men boarding and raising the Iranian flag. President Trump heading to Beijing to meet with Xi Jinping next week. Sources telling us here at Bloomberg the CEOs of Blackstone and Citi are set to join the president. A number of other CEOs have reportedly been invited to join the trip. And World Health Organization officials say the deadly hantavirus outbreak on a cruise ship doesn't risk triggering the next pandemic. At least 3 people are dead after a cluster of infections linked to a cruise ship in the Atlantic Ocean. Several more have been left seriously ill. That's your Bloomberg brief, John.
Nope. Yahara, thank you. Appreciate it.
You're
on the same page, right?
Well, yes, and
nope.
Actually, last night at dinner, it came up, and one member of the family just immediately said, "We're eating." Absolutely not.
There you go.
So on the
I like that member of the family. I'm like this.
Even you avoided going full doomsday.
I think just not over dinner.
I agree.
Not last night. I
or
think
in general.
Yeah. Or maybe, cruise ships.
Nope. To that too. I've got a lot of support from people who share that feeling. towards cruises.
There was a lot of self-righteousness in the anti-cruise society last night.
Didn't we all feel quite vindicated?
You're going to speak? You're this spokesperson?
No. Up next on the programme, signs of stability.
The labor market is stable right now, but it's not creating any inflationary pressures. The most likely probability is that we hold steady, and I think that's well positioned.
Up next, we'll catch up with Stephanie Roth of Wolfe Research, live from New York City. You're watching Bloomberg TV. Just off record highs and tracking 6 weeks of gains on the S&P 500, poised for that going into the weekend, the longest winning streak going back to 24. On the Nasdaq high this morning by 0.7, on the Russell up by 0.5. In the commodity market, quick check of crude right now, Brent and WTI. Skirmishes on Monday, skirmishes on Thursday. Here we are this morning, still haven't heard from Tehran about their response to the proposal from the US, and yet crude is down on WTI 94.70, and it's been lower over the previous 3 sessions on Brent.
Because there isn't a willingness to really ramp up some of the fighting. Yes, there have been missiles lobbed back and forth. Can you actually call this a ceasefire when there's firing happening? Well, maybe it's just an effort to not escalate significantly. Do you know why Iran hasn't responded? It's because a courier has to get to the Khomeini, to the Ayatollah, the current one, and get his sign off, and he's in a remote cave and he can't have any electronic communications.
Well, they did that yesterday,
through the different mountains. I mean, this is the reason why it's taking a while.
Well, the president met him yesterday. So the president could then, Pezeshkian met the Ayatollah yesterday. They could phone a friend to Pakistan, I think, and get that message across.
You know, he went over to him. I mean, did he?
Well, okay, now we're going into other realms of... I agree with you.
I don't even think that's a conspiracy theory.
They spent 2.5 hours together.
Right?
I just picture someone on camelback going through the mountains to the cave to find out what the tea leaf is, and then we'll see white smoke.
It's not a medieval movie.
It kind of is, honey.
Is that what it feels like to you?
I mean, given some of the reports, wow.
It's crazy how serious this actually is, and no one takes it seriously, isn't it?
People don't have a lot of information, so they're filling in the blanks in all sorts of creative ways.
You're watching too many AI-created videos, I think.
Honestly, I think it's the best use of all of this electricity.
Possibly. That's what it's going to be used for, isn't it? Slop.
That's
anyway,
what it's being used for,
we'll talk about this
totally
later.
Derailed.
Let's get to the bond market. Payrolls Friday, jobs data a little bit later, yields declining by just a basis point. The 2-year at 3.89. Under surveillance this morning, signs of stability.
If the conflict ends and oil prices come back down and that doesn't get passed into the broader economy, then I expect the underlying dynamics that we were facing prior to the conflict to return, which is policy is slightly restrictive, continues to put downward pressure on inflation. The labor market is stable right now, but it's not creating any inflationary pressures. The most likely probability is that we hold steady, and I think that's well positioned.
So here's the latest this morning. Payrolls due in just under 2 hours' time. The report expected to show back-to-back employment gains for the first time in nearly a year, which is crazy. Stephanie Roth of Wolfe Research calling for an above-consensus 80K, writing, quote, the labour market is showing signs of stabilisation despite the data being unusually volatile. Stephanie joins us now for more. Stephanie, good morning.
Good morning.
It feels like the ultimate random number generator. It's often felt like that, but now it feels like that even more. The fact that we haven't had back-to-back positive gains for that long.
Yeah, that's a bit concerning. And like we were talking about earlier, which is before we started, this would be a sign, if we do end up getting back-to-back gains, that the labour market is actually starting to show signs of improvement, which we do think is the case.
Nita Richardson said green shoots. Where else are you seeing green shoots?
You're seeing it, broadly speaking, on the industrial side. You're seeing activity starting to pick up, sentiment in business activities getting better. Consumption, maybe it's not necessarily getting better in a material way, but it seems to be quite stable in the face of elevated energy prices. So this all points to an economy that's doing quite well, and then you have the AI tailwind that's boosting CapEx in the related sectors even more so.
Is the economy doing really well in the right areas? Are we creating jobs in the sectors that actually do indicate some sort of cyclical uptrend, or is it just an indication that we're all getting older and sicker?
So that's what I think is going to be different about this print and the next couple.
Morning, Lisa.
Sorry, carry on.
That's what I think is going to be different about this print, is you're going to start to see the cyclical areas of hiring improve. And that's what we're going to be watching for most closely. Are you going to see retail hiring, leisure and hospitality? You've seen some positive signs in construction and manufacturing. And we think those are the sectors that are going to start to be adding jobs. And it's going to be coming less from healthcare and education.
You wrote a note recently, and it kind of explains the dissonance between the doom and gloom coming from the closure of the Strait of Hormuz and the lack of oil supplies, and then the optimism around the U.S. economy. Or the U.S. economy just seems really immune to what's going on. Is it immune or in denial?
I think it's neither of the two. I think we have stimulus hitting the economy at the same time we have a gasoline price shock. One big beautiful bill adds about $188 billion worth of consumer stimulus. That offsets the energy headwind by a significant amount. We could have gasoline prices running $4 to $4.50, and that doesn't even offset half of the stimulus that has come through to the economy. So there's a really solid buffer that happens to be supporting the consumer at a time where there is this energy price shock.
What do you need to see in the labor market report to indicate that any kind of price increases from oil or from some of the component prices tied to AI build-out can be passed through more easily to the consumer? We've heard mixed things from companies with McDonald's and Shake Shack talking about weakness in the lower income consumer. And then we see the aggregate numbers coming in gangbusters. What do you need to see in the actual labor market report?
Yeah, we're going to be watching the ones that are most closely tied to discretionary sectors. So leisure, retail, and hospitality, that's going to be the areas that will signal it to some extent. And what you've seen is it's been the K-shaped, just more signs of the K-shaped economy. It's the lower-end consumer that has been squeezed under this, but it's been the middle to upper-income consumers that are driving spending. And there was an interesting Fed report recently showing demand destruction by income group related to gasoline prices, and it's the lower end that seems to be really feeling it, and everybody else maybe only marginally so.
Is that start to potentially to get more problematic? Bank of America has a report out today saying spending slowdown. They saw this across the board just for a week, but potentially this can become more acute, and they call it a blip or a blockade. I guess we won't know. But do you think potentially that basically people are drawing down on these tax refunds? Now it's going to start to hit in a more material way?
I think it will start to hit on the sort of the middle to lower income consumer. Everybody else, most of their tax benefit comes not from refunds, but from lower taxes owed. And for the middle and upper income people, they're less likely to spend that right away. So that provides a longer buffer than would otherwise be the case. So you might see some more weakness or incremental weakness at the lower end, because these are the people who actually had a benefit because they received a check in the mail. That check has probably been spent for the most part. But the middle to upper income people, they still have these tax savings that will support for many months to come.
Arguably, that's what you're seeing in the restaurant businesses right now, the earnings of the last 24 hours or so.
Ultimately, it has been the lower income consumers. Everybody else is doing just fine. I mean, if you take a look at McDonald's, their bigger burger, what was it called again? I forgot what it was, but it was the one that was...
The Arch thing?
The Arch. Well, look at you.
Yeah.
I know that you are a frequent purveyor.
Very frequent.
But,
Been doing my channel checks, of course.
With the full family. But, those were actually were big hits. It just really is the lower income consumer that were pushing back on prices.
I think chicken nuggets 2019, the last time I had any McDonald's.
The truth is, I want to mock you.
Things got desperate that day.
Okay. It was a dark and stormy night. Wasn't sure about the Fed policy. Honestly, I can't remember the last time. It just is interesting, though, to see the K-shape kind of play out through some of these companies.
Stephanie, it's good to see you. Thanks for being here.
Thanks
Stephanie
for
Roth
having me.
there of Wolfe Research. It's got so expensive. That's what's crazy about this. We were speaking to Chris Verrone earlier on this morning, and he was leaving the commercial break talking about Shake Shack and just how much it costs to feed the whole family. And he was in New York City, you're talking like $90 just to take the kids out to get Shake Shack, which is ridiculous. So no wonder they can't put prices up anymore.
It's hard to call it fast food or have the same kind of cheaper outcome when you're talking about those kinds of numbers, $100 to get 4 burgers.
Yeah, it's fast, it's not cheap. And there's a difference. Up next on the programme, we'll catch up with Priya Misra of JPMorgan, Stephen Kirk of the Council on Foreign Relations, Sarah Kunst of Cleo Capital, Andrew Hollenhorst of Citi on this Payrolls Friday. Good morning to you all.
things are about as good as they've been in a really long time.
There's a lot of hype in the market.
This uptrend is being driven by a narrow cohort of names.
Within stocks, you have to favor companies with pricing power.
I think a rotational market is likely to persist.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
I left one out. There was a McDonald's breakfast, Spring 2021, Palm Springs. Just came back to me. And I want to be transparent and honest with people.
Well, I'm so glad.
Just in case.
What did you order? You know, it's true. Someone wrote in. They were like, I don't believe it. I fact-checked his receipts.
Egg McMuffin.
Oh, okay.
Hash brown.
Was it good?
It's decent.
Never had McDonald's.
It was fun,
breakfast.
you know. If I was going to frequent McDonald's, I don't. If I was, I would go for the breakfast.
They're trying to make their stuff healthier. They're trying to rival Starbucks. I've had a good Starbucks sandwich, and I think that there could be a similar.
When did you last have a Starbucks sandwich?
Very recently.
Oh, really?
Yeah, very recently when I travel. 100%. I'm not
like an airport. You do that at the airport.
Yeah, absolutely.
That's reeks of desperation. Okay, that doesn't sound like a plan. I mean, when did you last plan to go out? Like, you know, lunch today. I want to go out and get a sandwich from Starbucks.
My entire existence often reeks of desperation, so let's just leave it there.
Live from New York City this morning. Good morning to you all. The second hour of Bloomberg Surveillance starts right now. The price action looks like this. Equity futures on the S&P positive by 0.5%, up by 0.6 on the Nasdaq. Another series of skirmishes in the Middle East, and yet crude looks like this. Brent and WTI. We're not seeing a big move here. Brent unchanged, 100. WTI going nowhere, 94. What's interesting is this is how the bond market is set up. We're not seeing yields decline big time this week either, even with crude down on the week by 7%. Heading into payrolls, 389 on 2s, 10s, 437. The jobs report in 90 minutes' time. These are the guesses across Wall Street. The estimate in our survey, the median 65K. Mizuho in at 110. Citi, we'll catch up with Hollenhorst later. Citi, negative 15.
So, barring Citi's projection, all the others would mark the first back-to-back monthly gains, as you were mentioning earlier in the show, since May of last year, indicating just, how difficult it has been to gauge these numbers and how varied they've been from month to month. It also highlights how immune the U.S. economy could be potentially so far to what's transpiring in the commodity space. And that, to me, is the most interesting aspect. At what point is this viewed not as something that could crimp growth later on, but something that potentially boosts inflation at a time of already strong growth, giving the Fed a really difficult call later this year?
The U.S. is certainly insulated, but not 100% immune. When you look at where gasoline prices are, $4.50 is still a lot higher than many Americans were expecting under this administration, and especially into the summer months. But I do find it fascinating that the ceasefire is basically holding on, at least verbally. Even though we've had not just the skirmishes, but also this morning, the Iranians seized an oil tanker. There's constant tit for tat continuing within the Strait of Hormuz, and yet both sides are saying, no, ceasefire now continues to hold.
There are data points that matter to markets, and there are data points that matter to people. For markets right now, it's the average headline that matters right now. We'll say things like the economy can live with $100 a barrel crude. We'll say things like the labour market's doing okay, the consumer's resilient. And then you look at the disparity beneath the headline, captured by the corporates. And of course, this is not going to drive investor sentiment on Wall Street, but Planet Fitness, the consumer and economic backdrop have shifted. Dime brands, our price-sensitive, more value-oriented guests seem to be staying at home a bit more. Kraft Heinz, the Kraft Heinz CEO, in the last 24 hours, we're seeing negative cash flows in the lower income brackets where they're dipping into their savings. That's the squeeze in America right now. That's the real disparity.
Yeah, going on to say they're literally running out of cash. Stephanie Roth was on the show just moments ago, and she said that the New York Fed put out this report, which was actually really interesting, about how lower income consumers have been disproportionately affected by gasoline prices where they are. So you are seeing that trickle through in earnings. How does that feature into markets? Is it something where investors just penalize companies that cater to the lower income consumers? Or does it start to bleed into other income brackets? So far, it's the former, not the latter.
Futures right now positive by 0.5%. Coming up this hour, we'll catch up with Priya Misra of JPMorgan as stocks bounce back. Stephen Cook of the Council on Foreign Relations as the US-Iran truce faces another test. And Andrew Hollenhorst of Citi forecasting a very soft April jobs report. We begin this hour with stocks firming up ahead of a fresh labour read. Priya Misra of JPMorgan writing payrolls have been very noisy. We think we get an asymmetric reaction to a weak print as cuts have been priced out. Priya joins us now for more. Priya, good morning.
Morning.
That's the asymmetric reaction we might get in markets. What's the base case for you? What are you looking for?
I think the base case is some sort of stabilization. So the labor data had been weakening into the end of last year. The Fed cut rates, and then what we think we're seeing is sort of stabilization. I think the market has started to price in a re-acceleration. I really struggle with that. I think we're in the midst of a massive AI opportunity in terms of earnings, in terms of capex, and I think we're looking at that price action. This is a little bit of the narrative trying to fit the price action, that if the stock market is that strong, if the economic data has been okay, therefore maybe we're re-accelerating. We're not seeing signs. If you look at the job number, look at wages. Ultimately, there's a supply shock in the job market. There's a demand shock. The price is clear at wages. Wages are decelerating. So in our view, whether it's wages, whether it's hiring trends, we're in a low hire, low fire. I don't want to sound negative about the labor market. We're all getting older. So, healthcare and education is remaining this big concentrated, component of the job market. If you get, 0 to 60, and again, that payroll number is all over the place. So I would look at the unemployment rate. 4.2, 4.3, I think that's stabilization. That's not, re-acceleration. So some of the bond market move is pricing in the supply shock around energy. Some of it is this idea that maybe we are re-accelerating. All that hike talk is really this re-acceleration, or that is the labor market a source of inflation? I think that's the key. That's what I'll be watching for.
You used that word a few times, re-acceleration. You said the market was pricing in a potential re-acceleration. Is the bond market doing that?
I think the bond market pricing in half a hike this year is a little bit of that. The fact that the neutral rate's actually gone up. I mean, is that AI, or is that we're, if you think that the AI neutral rate or the neutral rate in the economy once AI has finally been absorbed is 4.5, then we're in accommodative territory. I really struggle to say. I sort of go back to the 90s, where I think people said you see computers everywhere except in the productivity data. We'll be debating the neutral rate for a long time. I'm not sure that the market should have that much conviction that the neutral rate is higher. So again, I struggle with is policy that accommodative? I think we might be in the realm of neutral. We might be slightly restrictive. That's where we sort of come out.
It doesn't matter if it's AI driving the strength. I mean, a lot of people have said, there's a lot of strength, but it's all AI driven. Well, isn't that relevant given the fact that it's a contributor to inflation, it's a contributor to capex, it's a contributor to GDP? Can you just say, well, it's not a contributor to a lot of people, so it's not a boon to the economy? I mean, how do you sort of separate that out?
That's a great point, because I don't want to negate the importance of AI. If it's going to raise productivity, labor productivity, that's a great thing. It's a good thing for the economy. It's a good thing for the U.S. When I think about Fed policy and I think about interest rates, that's where that Fed mandate, the dual mandate, becomes important, where the unemployment rate or inflation, price stability, I think there we should be careful around AI. AI is, I think, propagating that K-shaped consumer as well as the corporate sector. But if the Fed is looking at the entire economy, they have to be aware of that K-shaped aspect. I think they should look at, are we broadening out? I think the equity market wants to broaden out. In fixed income, I would say we're fairly broad, so it's not that concentrated. But, I think that's why it's important to say, is this a broad-based space in hiring? Will companies be able to pass on prices? I think that's important. That's why I want to say, if this is just AI, that can, continue the K-shaped and there's dispersion. But I would like it to be a little bit broader when we think about interest rates and what the Fed will do.
The reason why I find this so interesting is that PIMCO put out a report about the divergence between CPI and PCE, and it's kind of wonky, but the whole point is that the reason why PCE has risen, even though CPI has gone down, is because CPI is fed by housing costs, which have gone down, and PCE is fed by a lot of the components needed to build out artificial intelligence. It is driving inflation in the near term. So how does the Fed address inflation driven by AI while catering to the weakness in another sector that's not contributing to inflation at all? But if they cut rates, could lead to a melt-up, some kind of bubble-like characteristic in markets.
Right. I'm glad you brought that up, because that's another area where this AI shows up, is that dispersion. I think we have a new Fed chair who has already brought up a different inflation metric. I think the Fed even currently looks at a bunch of inflation metrics. They look at PCE, they look at CPI. Remember Supercore? Chair Powell had looked at Supercore. So I think this Fed is going to be very thoughtful, particularly if the hike conversation comes back, that is the inflation pickup AI driven? And in that case, I think they should downplay it. But I think that also becomes important if they're thinking about rate cuts. because I think they have to look at what is the underlying inflation. I'll come back to the labor market. If wages are not re-accelerating, I should say labor market and inflation expectations, that's where if those two start to tick up, the learning from 2021 and 2022 is give that a lot of weight. Those two had started to go up and the Fed was still somewhat in that transitory camp. I think they're not going to make that mistake again. So far, we're not seeing signs that that's picking up. You know, PCE is high and that could be AI driven. But as long as these other components, I think, stay low, I think the core of the committee, and I think, Kevin Walsh will be in that camp, will want to look through the supply shock on tariffs, the supply shock on energy, or any AI-driven sort of rise in inflation.
That means not hiking. Does it mean cutting?
I think the bar to cut is anyway a little bit higher, partly because we're in the midst of another inflation shock. And they remember, I mean, there's a path dependence to this. They remember that they made this mistake. And the other issue is interest rates are much lower today. At 5.5, it was easier for them to cut rates. If we're debating if neutral is 3 or 4 and you're at 3.6, I think that bar is a little bit high, so it does make it harder for them to cut. But I think that easing bias can stay unless you see wages start to pick up.
Priya, it's good to see you, as always. Priya Misra there of JPMorgan on the jobs report and the potential bond market reaction to it. Skirmishes in the Middle East. A proposal earlier this week delivered by the US to the Iranians. Through mediators, we are awaiting the Iranian response. We just heard from the Foreign Ministry just moments ago with some not too encouraging words.
Nope. Every time a diplomatic solution is on the table, says the foreign minister, the U.S. opts for reckless military adventure. Is it a crude pressure tactic, he asks, or the result of a spoiler once again, duping POTUS into another quagmire? And then whatever the cause is, outcome is the same. Iranians never bow to pressure. Now, this could just be verbal lip service for the regime, or is this an indication that they're not going to accept this one-page memo? We'll have to wait to see.
This from the UAE. 2 ballistic missiles, 3 drones targeted the country on Friday. Now, certainly those numbers are nowhere near as high as they were 2 months ago. But that gives you another sign of just how tense things have been just this week alone.
Yeah, and I believe that one of those actually hit one of their last remaining export facilities for oil. So definitely the pressure's still there, which is a reason why you are seeing some reluctance on the part of regional allies of the United States to take part in furthering the conflict in any way.
We've talked lots about this word fatigue and this market becoming desensitized. It's funny just reading these headlines and then the first thing I do is headline, market crude, what are we doing? Not much at all. $100, still basically unchanged on the session.
Yeah, how much is desensitizing part of the plan, right? I mean, this idea that the benchmark to the extreme, benchmark to the extreme, benchmark to the extreme, and all of a sudden the market says, all right, noise, 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 even if maybe it isn't.
Jobs, 8:30, a new distraction. Let's get you an update on news worldwide with your Bloomberg brief. Yahara has more. Hey, Yahara.
Hi, John. Iran is looking for alternative means to transport oil and grain supplies to get around the U.S. blockade of its ports. Tehran is increasing rail trade with China. Trains from Xi'an to Tehran going from around 1 per week to 1 every 3 or 4 days. The business delegation expected to join President Trump's summit with Chinese leader Xi Jinping is taking shape. Sources telling us here at Bloomberg, CEOs from Blackstone and Citi are set to join the trip. Trump and Xi are scheduled to meet in Beijing next Thursday. And shares of CoreWeave are falling in the pre-market after the company put out a disappointing forecast for the current quarter. That's raising questions about slowing growth, especially as the company ramps up spending to build out AI infrastructure. That's your Bloomberg brief. John.
Hey, Yahara, thank you. Appreciate it. Up next, a fragile ceasefire.
They trifled with us today. We blew them away. You won't have to know. If there's no ceasefire, you're not going to have to know. You're just going to have to look at one big glow coming out of Iran. And they better sign their agreement fast.
The president reportedly calling it a love tap, which is real. That's actual news. Whenever you share those things with people, it's almost like, is anyone actually going to believe that the president said that? But apparently that's what the president said.
Truth be told, when I first heard that, as well as the butterfly that died, spiraling gracefully to the grave, I was like, you've got to be kidding me. And then I looked and yes, that was actually exactly what it said.
There you go.
Yeah, there you go.
It's that kind of news cycle. Up next, we'll catch up with Stephen Cook of the Council on Foreign Relations, live from New York City this morning. Good morning. Live from New York City. It's a love tap.
Yeah.
We're still talking about that.
I know. I just,
right?
Let's move on.
Let it go, Bramo. Let's move on. Mizuho, 110. That's the estimate from them today at 8:30 Eastern Time. Bank of America, 80K. Citi. I'm looking forward to catching up with Andrew. Citi's at negative 15 for this payrolls report this morning. The median in our survey is the mid-60s, the mid to high 60s. We'll see what we get. In the commodity market at the moment, Brent and WTI shaping up as follows. Brent crude at 100, WTI at 95. There is every reason this week for this oil market to be rallying. Skirmishes not once but twice. We haven't seen the Iranian response to the proposal just yet, and crude is down by 7% or something like that on the week so far.
Yeah, you noted, though, something interesting that I think is really telling, which is longer dated contracts over in December that expire in December for Brent and WTI have not come down nearly as much as some of the near-term contracts. That divergence gives a sense that people's sense of this conflict is changing. Maybe not an escalation, but how high is the bar to get to some sort of free transit through the Strait of Hormuz?
Just about holding on to triple digits this morning. Under surveillance this morning, a very fragile ceasefire.
They trifled with us today. We blew them away. They trifled. I call that a trifle. I'll let you know when there's no ceasefire. You won't have to know. If there's no ceasefire, you're not going to have to know. You're just going to have to look at one big glow coming out of Iran. And they better sign their agreement fast. Let's see if they are willing to sign it.
So here's the latest this morning. The US and Iran exchanging strikes near the Strait of Hormuz, with President Donald Trump calling on Tehran to make a deal to end the war. Bloomberg's Tyler Kendall has more from Washington. Hey, Tyler.
Hey, John, good morning. Well, Washington right now is maintaining that the ceasefire is still in full effect, at least for the moment, even as President Trump does renew his threats to resume military operations if Iran doesn't come to the table on a deal. Now, this latest flare-up in fighting was, of course, centered in the Strait of Hormuz, as CENTCOM confirms that it did hit Iranian military assets in retaliation for Iran going after 3 naval warships that were trying to transit through. The U.S. says that no U.S. assets were harmed during this flare-up, but it does underscore how Iran is trying to maintain its grip over that waterway amid new headlines this morning that Iranian state media did publish a video showing the country's military seizing an oil tanker that appeared to be carrying Iranian oil, though they say was, quote, at risk of attempting to disrupt oil exports and interests of the Iranian nation. It's going to be something to watch because we know that the risk is growing for regional allies as well, as the UAE confirms that overnight it did intercept multiple drone and missile attacks aimed at the country. All of this risking any potential progress when it comes to an agreement, as Bloomberg News does report that the White House is still expecting that they could hear an Iranian response to the proposal that was put forward as soon as today. And new also, we got this response, John, from Iran's foreign minister, writing in part, quote, that Iranians never bow to pressure. It's going to be something to watch because we know that this White House is trying to clinch a deal before President Trump heads to China next week.
Tyler Kendall with the latest in Washington. Tyler, thank you. Stephen Cook of CFRA writing the White House seems to have backed itself into a situation where it either escalates or hands Iran a strategic victory. Stephen joins us now for more. Stephen, welcome to the programme. We've got a decent understanding of the details of the US proposal. We've been waiting a day or so. What kind of response are you expecting from the Iranians?
I don't think it's going to be a positive response. The Iranians believe that they have more time on their hands to wait the president out, to force the United States to capitulate. The U.S. intelligence community yesterday issued a report indicating that they believe that the Iranians can live like this for months. With rising gas prices and other concerns for the American consumer, it does not seem that the president has as much time. Either way you have it, I think the statement from the Iranian foreign minister would suggest that we are still at a stalemate.
When it comes to that report that Washington Post was talking about with the CIA, they say that the naval blockade, the Iranians could survive that for at least 3 to 4 months. We're talking about basically the entire summer, Stephen. Do you think then the administration has to rethink its plan?
Well, this is what I was saying when I suggested that the president has backed himself into either escalation or capitulate to the Iranians. If the Iranians can hold out, as the CIA indicates, they're not going to be forthcoming with any kind of proposal that requires them to give up enriching uranium not having at least partial control over the Strait of Hormuz, and giving up their ballistic missile program. We've already dropped basically the issue of proxies. So they are in a very strong position from where they believe they're in a very strong position. So the answer then is either for the United States to come off of its demands or for the president to actually escalate and try to force them to capitulate on the battlefield. So far, they haven't capitulated in either place, the battlefield or the negotiating table.
When it comes to the president's three red lines, proxies, ballistic missiles, and a nuclear weapon, is there any indication that we are closer on any of these aims?
No, we're not closer on any of them. Again, the Iranians have remained steadfast that they have a right to enrich uranium. They're not going to give up their ballistic missile program. That is a significant threat to the neighbors that they want to hold on to after this conflict. And the proxies, although greatly diminished, are useful to them. Now add the new leverage that they have over the Strait of Hormuz, and the Iranians feel that they have all the advantages here. In addition, this is a regime that has already forced the Iranian people to suffer. At the low end of the estimates, they killed 7,000 people in a matter of days in January. At the high end, 30,000 people. They are prepared to live out this blockade and make Iranians eat dirt if they need to.
Every single analyst who's come on from Wall Street so far this morning has not wanted to talk about Iran. They have not wanted to talk about the Strait of Hormuz. They've wanted to move on. For all the people who are trying to tune this out because ultimately they have confidence that it's going to turn out one way or another, how do you explain why this is still incredibly important and potentially revolutionary when it comes to reshaping global alliances as well as supply chains?
Yeah, well, first, I think it's important just in terms of the American consumer. It costs a lot more money to fill up your car, your SUV with gas these days, and that's going to have an impact on everything that people buy eventually. We are somewhat insulated from it here in the United States because we're wealthy, but in time, this is going to really pinch. I'll note that the Israelis recently agreed to send jet fuel to Germany so that Lufthansa can maintain its obligations and its flight schedule. So this can be very, very disruptive. In terms of reshaping global alliances, we are seeing a realignment in the region starting to take shape. You have the Saudis, the Turks, the Qataris, the Pakistanis on one end, and then you have the Israelis, Emiratis, Bahrainis, and other extra-regional actors like Greece, Kenya, Ethiopia, Somaliland, on another end of an alignment here. The expectations that American policymakers have had over 25 years about an alignment of Saudi Arabia, the UAE, Bahrain, Egypt, Jordan, and virtually and not so virtually Israel have been shattered as a result of this conflict, and we're going to start seeing different blocs emerge. The Iranians are now empowered in ways that no one really had imagined when the president launched this conflict on February 28th.
Stephen Cook of the Council on Foreign Relations. Stephen, thank you, sir. We've had the US proposal. We're waiting for the response from Tehran. Simple question, what kind of response are you expecting, Stephen? Not a good one.
Yeah, they think that they've got the leverage right now in terms of the pain that can be tolerated by the public. And that's a really important point. Even if they are seeing huge economic issues, they've been willing to, make their people, as he said, eat dirt. I mean, there has been a huge lack of care with respect to the state of the average person.
This was not in the president's playbook when it comes to geopolitics and military strikes. This excursion into Iran is so different to everything else we've seen from President Trump. Usually surgical, limited, very time-dependent, super short window with very clear objectives.
And that's what we saw last summer when it comes to the bombers that went into Iran, when it comes to the nuclear facilities they bombed. This is very different than what we saw in Venezuela. The Iranians are willing to wait this out. They don't have the same pressure from an electorate the way we do.
Futures positive by 0.5%. It's Payrolls Friday. "60 minutes away from the jobs report. Futures positive here on the S&P 500. On the Nasdaq, up by 0.75%. On the Nasdaq, the comparisons to 1999 this week, overwhelming. Jonathan Krinsky, BTIG. The Nasdaq reached a 13% spread above the 50-day moving average. The last two times we saw that, while also at a 52-week high, were back in 2020 and 2000. The former led to an immediate 13% drawdown over the next 2 weeks. The latter was the absolute dead highs of the dot-com bubble. Lots of that doing the rounds.
In part because of the scope of spending that some of these companies have planned. $800 billion potentially this year and more than $1 trillion next year, according to Morgan Stanley. Next year, it will dwarf the entire spending for the Defense Department for the United States, just to give some scope of how big this is. And these are the companies that have generated all the gains. So people are getting nervous as we get to higher and higher heights.
Futures this morning bouncing back by 0.5%. Let's turn to crude. Brent, WTI shaping up as follows. Brent crude 100 down for the last 3 days coming into Friday, up by only 0.5%. That is what a skirmish is worth in the Middle East right now. That's what it's worth. 50 cents on a price of Brent.
Traders don't understand how to price this out because there's been so much opacity and tit for tat, even when it is kinetic, even when there are missiles being lobbed. The idea that it isn't leading to escalation is enough for people to take the temperature down. Essentially, the message seems to be, if the U.S. wants to bring the temperature down, and Iran evidently on the margins wants to bring the temperature down, well, so too will the market. And that is essentially the message this morning.
Let's not bring in bond yields down. Look at bond yields this morning. Twos, basically unchanged. 390, 10s, 438. Just can't get away from 440 on 10s. Can't get away from around 390 on twos heading into payrolls.
You've even seen break-even rates start to creep up just a touch. This really is driven more by inflation expectations than it is by real yields going higher, which gives a sense of what's being driven by the underlying momentum. Why today's jobs report could be particularly interesting. Yes, we want to see strength, but on the other hand, does that feed inflationary expectations?
65K. I still can't believe the stat you shared with us this morning. We haven't seen back-to-back positive gains for a year.
Yeah.
Isn't that wild?
I couldn't believe it when I read it. And it was actually Jim Reed over at Deutsche Bank. When I read it, I thought, no way, this can't be real. So I double-checked it. And sure enough, negative, positive, negative, positive.
Crazy.
Again, choose your own adventure.
Andrew Hollenhorst is looking for negative again today. Negative 15K. So we'll catch up with Andrew and see why in just a moment. As we count you down to the open, about 3 hours away. 2 hours away now. Let's get you some morning movers. Danny Berger has more. Hey, Danny.
Hey, John, some earnings and deal news to work through. First, with the earnings, CoreWeave, they did beat on their first quarter, but the disappointment you can see here in shares down 7.25% was their projection for the second quarter. Revenue missed, and at the same time, they're increasing their CapEx spending. That is a dangerous mix for investors, and hence why you are seeing that selling. Because if you're going to be spending more in CoreWeave, along with Oracle, have been the poster child for fears of overspending on an AI bubble infrastructure. So shares now down nearly 8%. Elsewhere, some deal news between NVIDIA and IREN. IREN is going to be providing 5 gigawatts worth of AI infrastructure for NVIDIA. At the same time, they're going to give them about $3.4 billion worth of cloud infrastructure. It's the new deal landscape. Companies can't just buy each other because they need this infrastructure now. So they're shaping these kinds of deals, which also gives NVIDIA warrants to buy IREN shares. So those are up 9.5% this morning. We also heard from Wendy's. We heard from McDonald's and Shake Shack yesterday. It's the value-oriented type menus that seem to be doing well. Wendy's beating a very clean earnings, though there was a little bit of disappointment when it came to U.S. comparable same-store sales. It's a company that had been struggling last year, but they made this big song and dance that they're going to reorient their menu around value, rather. The CEO saying that they are doing the turnaround. They're making progress. Shares are up more than 5%, John.
Interesting, Danny. Appreciate the update. Danny, thank you. More from Danny in the next hour. On our radar this morning, the U.S. awaiting a response from Iran on its peace deal proposal. Trump threatening to hit Tehran even harder if a deal is not reached. Iran's foreign minister responding on social media saying, quote, Iranians never bow to pressure. Elsewhere, the president setting in a new deadline for the EU to finalise a US trade deal, warning auto tariffs will, quote, immediately jump to 25% if the pact isn't ratified by July 4th. Interesting date. Next up, next week's summit between Chinese leader Xi Jinping and President Trump remaining on track. Sources telling Bloomberg the Blackstone and Citi CEOs will join the president in Beijing. Semaphore reporting NVIDIA, Apple, Boeing, all of those executives will also make the trip.
It's notable. This is the first trip by a U.S. president to China to meet with the Chinese leader going back a decade. So this is highly unusual, and it comes at a fraught moment given what's going on in Iran. These two events really coinciding to give a sense of why President Trump wants to bring the temperature down, to not have this be the main theme for their discussions. They need to reset expectations, keep tensions low enough to maintain some sort of uncomfortable partnership, even as there is this increasing moving away from one another.
That's why I want to know how much scope there is for upside of deals that actually happen on this trip, because it feels like they're holding on to this détente. And there's a lot of issues right now in this relationship. On top of that, Trump's 10% global tariffs were declared unlawful yesterday. How much does it weaken his hand at the negotiating table? Also, we have an exclusive story about how some NVIDIA chips potentially, suspectedly, were smuggled to Alibaba via Thailand. And the NVIDIA CEO likely going to go on this trip. It potentially will become a challenging discussion at the table, even though you know the Chinese and the U.S. are going to want to make sure it looks like everyone's smiling and everyone's clapping for this great relationship.
There are some awkward questions that need to be asked, and I imagine those awkward questions won't be asked in public, and we won't see much of that taking place.
Which, again, is the reason why people aren't expecting much by way of resolution to anything, but rather just paving the way for further talks and some sort of framework for the relationship.
Unless I have a chance to ask them questions, it will be these awkward questions.
I imagine you won't be given that opportunity now, if anyone's watching. Let's see. CoreWeave shares falling in the pre-market after giving a disappointing forecast, and the stock is down by 7% in the pre-market. Sarah Kunst of Cleo Capital writing, CoreWeave will be an early domino to fall in any real tech correction, and if I had gains there, I would lock them in and run. Sarah joins us now for more. Sarah, welcome to the programme. Why is CoreWeave in this move today potentially more signal than noise?
Because this is a company that has just sort of struggled and has kept getting lucky because they keep sort of pulling out these deals to be able to build more data centers. But when you look back to their IPO, the sentiment around that, I don't think that those concerns have materially changed. This is not a company that has super solid financials. It's gotten incredibly lucky that very solid companies, the NVIDIAs of the world, the Metas of the world, have all decided to sort of YOLO their CapEx into data center spend, but I don't know how long that's going to last.
Does it tell you something about the broader AI ecosystem or just this name? And I think that's what I'm getting at here.
It's a little bit of both. I think that CoreWeave is a uniquely fragile company in the ecosystem. We certainly saw that, before their IPO. That was widely the sentiment. And so, I would go back and look at some of those notes then and say, has much really changed? But I think that the broader AI market, the question is, when will they make money? We know that on the private side, we're seeing a lot of unease around OpenAI, not just the lawsuits, but, questions of how sustainable is their current business model? Is there going to be huge price hikes from OpenAI and Anthropic, which then drives a lot of the more casual users, the smaller business users, off of using them? How much efficiency are even really big enterprises actually getting from AI in the workplace? There's a lot of data that shows that it might be close to zero, or that compute credits are actually more expensive than just hiring a good, solid junior engineer to do some of this work. And so I think that we're spending like it's a sure thing, but when you look at the data, the ROI, even the revenue, it's really unclear if it is.
You talked about OpenAI, and we were discussing earlier this morning how SoftBank is having trouble getting a margin loan for $10 billion backed by their stake in OpenAI because the creditors are concerned about the valuation being assigned to OpenAI. How much is this just winners and losers coming to the surface versus a sense that maybe the entire ecosystem is overpriced right now based on very high expectations and very high costs?
Look, I love Masa because that guy is great for entertainment, but I don't know that if you can look at SoftBank's struggles and sort of widen it out to the rest of the market, because they operate in an incredibly unique way. If you think back to the WeWork days and Uber and all of that. So, I wouldn't be sort of overly looking at them as the signal. I think that big question does come back to when will we see companies outside of the alphabets of the world make real money on this? Obviously, NVIDIA, the chip makers, are making a lot of money, but that money is only as good as the demand for the chips, which really could, kind of slow down and fall apart at any time. The other piece of it is, as the global economy slows and contracts, which we know is happening, there are fewer enterprises who need AI. There are fewer people who are necessarily interested in paying for that subscription to be able to get, a slightly better restaurant recommendation or slightly better travel recommendation, because they're not doing that. And so as those subscriptions wane, the entire industry sort of falls apart based on a lack of demand.
I'd love your take then, Sarah, on Cloudflare saying that they were planning to cut 1,100 people because they can replace them with artificial intelligence. Notably, the shares are down significantly in pre-market trading after that announcement, not being treated as exactly a cost savings. Why don't you think that that's being treated by the market as evidence of some of the productivity gains and actual monetization of some of these tools?
I think at this point, we've kind of heard that story, right? We see people go in, they do a big layoff, they say it's going to be great, we're going to do AI now. And then they realize, oh, the AI is not working that well. They have to kind of hire people back. It also is often seen, and certainly not in Cloudflare's case, but it's often been seen in the market as, hey, maybe there's something wrong with the underlying business. Maybe there's something wrong with the revenue, and they are covering that with the AI-driven layoffs because that's a buzzword we like. And so I think that there's just a little bit, we saw the same thing with Meta a few weeks ago with their layoffs announcement. There's just a little bit of, I think, kind of people don't really buy that an AI triggered layoff is a good thing anymore.
Sarah, there's a report in the Wall Street Journal about a recent call the vice president had with the heads of all these companies, Elon Musk, Dario Amodei, Sam Altman, and expressing alarm about artificial intelligence. Do you think this White House in Washington is going to try to put a leash on some of these companies?
I think that the White House is going to do what we've seen it do over the last few years, which is that you have to stay in their good graces. It's a bit of a pay to play. And so I think that what you're going to find is that they're going to say, it's a little bit like when the mob comes into your store and says, we want to make sure that you're taken well care of. And so I think that these AI companies are going to have to very aggressively stay on the sort of right side of the White House, of the administration. I don't know how much sort of the anti-data center sentiment, which we're seeing sort of bipartisan in communities across the country, is feeding into this. But I do think that, one, J.D. Vance is trying to set himself apart a little bit from the rest of the administration and look like he's caring a little bit more about Main Street issues. Anti-data center very much is a Main Street issue right now. And then two, this administration wants to make sure that everybody knows that at the end of the day, they're going to owe the White House something. And this is a great way to remind them.
Sarah, is any of that new? I remember when these companies used to dress themselves up in the cloak of liberal values and make out they were super progressive and left wing because they were worried about progressive people down in Washington, D.C. Is any of this new? Just a different flavor, isn't it?
I think it's a certainly different and more aggressive flavor in the U.S. I think that the actual kind of the money that's changing hands around the ballroom and things is certainly a slightly more banana republic take on it. But I think that, to your point, people tend to like to play nice with the most powerful government in the world for good reason.
Don't regulate us. We want to connect the world. Bill Gates cares about climate change. We've seen this a million times.
To Sarah's point, I think to Sarah's point, there is a feeling that with the Anthropic move and labeling it a supply chain risk and some of the concerns around what could happen if you're not in the good graces of people of the administration, it has definitely highlighted how close the performance of some of these companies are. The fact that Susie Wiles had to come out and say, we don't want to pick winners, the fact that she had to put that out on social media gives you a sense of how people do feel like this is something that is slightly of a different flavor.
Sarah Kunst of Cleo Capital. Sarah, thank you. I'm not saying it's good. I'm just saying it's not new.
It's never been new. The idea that it's been a pure capitalistic society on 100% levels with nobody who curries favor with Washington, D.C. is not new. I will note that when I talk to certain CEOs, they now spend more time in Washington, D.C. than they ever have before. And part of the reason why is because if they don't, that will be a liability for them. And if they do, that could potentially affect their companies in much more significant ways. President Biden didn't want a relationship with them, which was to a detriment.
Well, exactly.
And so I think this does feel different.
It's full whiplash and 180 for corporate America, which this administration wants to be in contact with on a weekly, if not daily basis, depending on what industry you sit in. For the Biden administration, no one used to call executives. It was far and few between. The only individual that really had a connection with Wall Street in the C-suite was Gina Raimondo.
I'm not talking about the Biden admin, by the way. I'm talking about the Obama admin. That's what I'm talking about. I'm talking about the very start of the tech boom. These companies that we know today, they dressed themselves up in very liberal values to make sure they weren't regulated down in Washington, D.C. Facebook did it, Google did it, Microsoft did it. And I'm just saying that this is a different flavour of something very similar to what we saw on the opposite end of the political spectrum. Now, I don't think any of this is good. I don't like any of it. I'm just saying it's not that new.
Part of it was that in a previous iteration, it was a moral persuasion and it was sort of a political persuasion. Now it's a transactional persuasion. And that, I think, is a different beast for some people.
I think we all got there in the end, to the same place. A similar place, at least. Let's give you an update on news elsewhere this morning. Your stories worldwide with your Bloomberg brief. Yahira has more. Hey, Yahira.
Hi, John. SoftBank is downsizing plans for a $10 billion margin loan backed by its stake in OpenAI. Sources telling us here at Bloomberg it's now cutting the target to around $6 billion as some creditors raise concerns about how to value the unlisted company. Apple is in the late stages of development of new AirPods with built-in cameras. Sources telling us here at Bloomberg the earbuds will act as eyes for the Siri digital assistant. They're expected to be part of a new wave of AI products from Apple. And the U.S. saying Thailand likely helped smuggle NVIDIA chips to China. Sources telling us here at Bloomberg a key company behind Thailand's national AI effort is suspected of helping smuggle billions of dollars worth of super micro servers containing advanced NVIDIA chips over to China. That's your Bloomberg brief. John.
Hey, Yahira, thank you. Appreciate the update. Thank you. Up next on the program, signs of improvement.
This would be a sign, if we do end up getting back-to-back gains, that the labor market is starting to show signs of improvement. This all points to an economy that's doing quite well.
Up next, we'll catch up with Andrew Hollenhorst of Citi, live from New York City. You're watching Bloomberg TV. Stocks positive by 0.5% on the S&P, up by 0.8 on the Nasdaq, on the Russell by 0.5. An update on crude for you, Brent and WTI. If you're just joining us this morning, Brent at 100. If you saw that price, you probably wouldn't realize what's even happening on the ground right now in the Middle East. A series of skirmishes again, and just about holding on to a ceasefire. And again this morning, I don't even know what a ceasefire is if you're firing all week.
The less you know. Honestly, that's I keep going back to Chris Verrone and his fantastic logo for this year.
The less you know. The less you know.
Yeah, it's like the PSA. The less you know.
Right. Just keep buying. Under surveillance this morning. Signs of improvement.
This would be a sign, if we do end up getting back-to-back gains, that the labor market is starting to show signs of improvement. You're seeing it, broadly speaking, on the industrial side. Sentiment in business activities getting better. This all points to an economy that's doing quite well. That's what I think is going to be different about this print, is that you're going to start to see the cyclical areas of hiring improve.
So here's the latest this morning. Payrolls dropping in less than an hour's time. Citi with a street low estimate of negative 15K. Andrew Hollenhorst of Citi writing the slowdown in the pace of labour force growth means the break-even level of job growth needed to keep the unemployment rate unchanged has declined. Andrew joins us now for more. Andrew, good morning.
Good morning.
Let's get to that minus sign. Where's that coming from?
Well, I think we're trying to recognize two things that are really not that controversial, but then get us to an out-of-consensus forecast. So, number one, this is a low hiring job market. We know that it's low hiring, low firing. That's why the unemployment rate has been pretty stable. But hiring demand is low and weak. So that's number one. Number two, these jobs numbers have been very volatile. We've had negative readings in terms of a decline in payrolls every other month for the last several months. So you put those two things together and you say, okay, the average is low. It's swinging around wildly. We just got 178,000 last month. It makes sense to estimate or project that we're going to get a lower number this month.
Does it also make sense to say, you know what, we might get a lower number, you won't see a corresponding pickup in unemployment?
Yeah, that's right. I mean, we do have the unemployment rate just ticking up slightly to 4.4%, but it's been in this range, 4.3 to 4.5. That's kind of the stability that people are talking about. We think, at least for this month, that we'll still have relative stability in the unemployment rate. So, you know, we're pricing in half a hike for the Fed, so you probably get a market reaction if we get our number for payrolls, if we get a decline in payrolls. But that unemployment rate is really going to be the key number for the Fed.
So essentially what you're saying is that the random number generator that John calls is sort of less relevant now, that headline number shouldn't really make that much of a difference for a lot of investors.
No one knows exactly where that break-even number is on payrolls. What amount of job growth do we need to keep the unemployment rate unchanged? And as long as there's uncertainty around that, we'll really be watching the unemployment rate. So yes, it's the trend in the unemployment rate. It's what we're seeing with jobless claims. I do think those things can weaken as we go into the next few months. There's a residual seasonal pattern. We have this kind of same pattern every year where the summer months we get some weaker labor market data. That brings the Fed back to cut. That happened the last 2 years. So we do have that in our forecast. But in terms of what people should be focusing on, yes, the unemployment rate.
This is what I'm struggling with. You have broken indicators. You have headline payrolls that might mean nothing in terms of what they actually indicate about the state of the economy. You have jobless claims that also seem to be somewhat broken on the margins in terms of their forward-looking purposes. Why not just focus on inflation then and say this is telling us the economy is strong enough to pass along price increases?
Well, if you're the Fed, you have to look at inflation. You have to look at the labor market. These measures do have issues and noise and methodological problems, but it's the best that we have, and you just have to smooth through more data and try to get a sense of what's going on. So if I look at the labor market right now, I would say it's stable but very fragile, right? Low hiring, low firing, that's leading to some stability, but it's an uncomfortable stability. If I look at inflation, there I have a whole bunch of different metrics I can look at. You were mentioning it earlier. If I look at PCE inflation, we're pretty elevated relative to target. If I look at core CPI inflation, we're actually running on a monthly basis. We're running numbers that annualize to close to 2% inflation. You look at the individual subcomponents, those are close to 2%. So a huge question for the Fed, and as Kevin Warsh comes into Fed chair, is which measure is he going to focus on? What are Fed officials going to really emphasize? Is it going to be core PCE, which is running too high, or core CPI, which is closer to target?
If we get your potential estimate of negative 15K today, can they just ignore inflation and say this gives us room to cut?
I think it does go back to what's happening with the unemployment rate and what's happening with several months of data. We've had negative readings in payrolls and the Fed hasn't cut. And we've had even Fed officials who have been relatively dovish, people like Governor Waller, who have acknowledged that labor force growth is slower now. So it's not going to be that surprising to get a zero payrolls number or a negative payrolls number. If you get a series of those numbers and we're averaging lower, then I think that tells you something. Now, relative to what the market is pricing, we're pricing some probability of a hike or hikes that are more likely than cuts. I think it does send a strong message against what the market is pricing.
Bramo, you nailed it. These indicators don't mean as much as they used to. The meaning of it's changing, but also the contribution to growth is coming from elsewhere. It's coming from things like CapEx. And for this market, this used to be the number every month. This was it. Set the tone for financial markets. Don't think that's the case anymore in quite the same way.
You've seen an unprecedented divergence between the economy and the market as defined by the S&P 500, with the weights of the top 5 companies accounting for half of all stock market gains going back to April 12th. So it gives you a sense of how divorced from some of these underlying indicators, even if they were accurate, the market has been. Now you add some noise to it. It's hard to know how much this market will react.
Just plot the chart. Have a look at payrolls growth over the last 12 months. Compare it to earnings in corporate America and the S&P 500. Just hasn't been part of the story.
Which is why it was so shocking to think that this would be the first back-to-back gains for jobs going back to May of last year, if this is a positive number.
Andrew, in 34 minutes, if this number has a negative sign in front of it, we'll be thinking of you. And if it doesn't, we'll forget your call, OK? Andrew Hollenhorst of Citi. Appreciate it, sir. Up next, Nadia Lovell of UBS, Mike Collins of PGIM, Francis Donald of RBC, Jeff Rosenberg of Blackrock. The third hour of Bloomberg Surveillance, next.
The economy is bruised, but not yet really battered.
This is a labor market that's very unlike any that we've seen before.
It's really challenging at this juncture to get a really good sense of the labor market.
There really is very little evidence that the labor market's falling apart at this point.
The underbelly of labor, I think, is softer than most people appreciate.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, the third hour of Bloomberg Surveillance starts right now. Your scores, the price action looks like this. Bouncing back by 0.5% on the S&P 500, up by 0.75% on the Nasdaq. In the commodity market, crude just about unchanged despite the chaos. I think we can call it that this week. The chaos and volatility, the tension in the Middle East. Brent crude right now 100 and up by 0.5%. Bonds, 2s, 10s, 30s, yields just about unchanged. 10s at 437, 2s at 390. Heading into this, 29 minutes away. The payrolls report just around the corner.
The U.S. economy has been strong. That has been a feature throughout this entire conflict in the Middle East, and the reason why so many Wall Street analysts have had the luxury of increasingly ignoring the chaos that you were talking about in the Middle East, at least when it comes to near-term stock market performance. Do we get confirmation of that in the numbers that come out today? Or is it treated like an afterthought, like so many other aspects of the news cycle right now, in just to prioritize the AI spending and how much that really is dominated in the U.S. economy?
AI spending and the conflict in the Middle East absolutely dominating the financial markets, or lack thereof when it comes to the oil market, depending on everyone just getting used to the conflict. But the scope we have on the jobs makes it almost difficult to understand the impact. Negative 15,000 to 133,000. Jonathan, you called it a random number generator. That is exactly what it feels like it's going to be in 30 minutes.
Well, it's negative 1 month, positive the next. Negative 1 month, positive the next. There's been so much chop in the last 12 months.
Yeah, if we do get a positive number, we keep repeating this. This would be the first back-to-back positive reads in the jobs number going back to May of last year. It has been a difficult number to get a handle on, which is the reason why people are focusing on the unemployment rate. With the unemployment rate, if it stays at 4.3%, what signal are people getting? There's nothing to see here. We're still in that low-hire, low-fire dynamic. If we see a drop down to 4.2% with the inflation that we're seeing pick up in certain metrics, how much does that put the Fed in a corner to at least remove the easing bias, if not signal the potential for some sort of rate hike?
It would be nuts if we retained an easing bias in the face of that, wouldn't it? It's kind of crazy right now that you're seeing central bank hikes through this week. Norway, Australia, the ECB on course to hike if nothing changes, maybe by June, and a Federal Reserve with better economic data, by the way. Really powerful data in some places, particularly the capex we're seeing in this country right now, a boom. And we're holding on to an easing bias.
And you can tell that this is clearly making some Fed officials uncomfortable. We saw that from Susan Collins, who is not a voting member, but gave a discussion to Bloomberg talking about how she would have also dissented in the language. That said, people are putting a lot of stock in Kevin Warsh and who he might be coming in, what he's going to be focused on in his desire to cut rates in tandem with some of the desires coming from the White House. That's going to be tested, though, if the data doesn't cooperate.
Hasn't he got a bit of cover right now to do nothing?
Absolutely.
Feels that way.
And Treasury Secretary Scott Bessent has come out and said you can hold it steady. Question is, if the data gets that much more uncomfortable, how much does he have to come in with something of a
That's what Chris Verrone said at the start of the program. Basically, he thinks that Kevin Warsh has some leeway to keep things status quo as is. He said it would be acceptable. I said acceptable to who? He just sort of smiled. But we know who this would be acceptable to.
Stocks positive this morning by 0.5%. The jobs number, 8:30 Eastern Time. Coming up, Nadia Lovell of UBS with stocks rebounding. Michael Collins of PGIM on the growing divide inside the Federal Reserve. And Francis Donald of RBC breaking down the latest payrolls report. We begin this out with stocks edging higher and crude hovering near triple digits. Nadia Lovell of UBS Global Wealth Management writing, we remain constructive on US equities earnings momentum, but expect a bumpier path as energy and geopolitics reintroduce headline-driven volatility. Nadia joins us now for more. Nadia, good morning. It's good to see you. Year-end price target, 7,500, right?
Yes. As
bull
of now,
case, what have you got, 8,400 bull case? Is that in play?
We're not quite there yet to pull the trigger on 8,400, but does it feel like we could be on a path to above the 7,500? It does feel so today. When you think about it, look what the market is trying to price. It's trying to price that stronger micro, but at the same time respect that louder macro. When you look at the earnings season that we've had so far, like, wow, very strong earnings, and that's being driven by the AI demand. But at the same time, you do have concerns around inflation, concerns around higher rates that could be a headwind to the market. Now, don't get me wrong. As I noted, we're very constructive on the market. We still think this is a risk on take, but it's probably becoming more conditional because now you're sort of moving into that environment where the market is probably less tolerant of good and not great than it was, just a month or so ago.
Let's just sit on the super powerful earnings and the charts. Some of the charts in certain sectors, chips, for instance, have gone vertical. Parabolic is the word that gets thrown around a lot. What do you make of the comparisons to 1999? Do you think they're fair comparisons?
I don't think that they're fair because the spending is still very much being supported by the balance sheet and by free cash flow and a little bit more by the balance sheet more recently. But the demand is very strong. Look at the earnings season. The fact that you're seeing cloud growth by some of the large cloud providers at 40%. You're also seeing improvement in terms of ad-driven efficiency coming through from AI. So the monetization is happening, and that's helping to fuel the spending. I mean, we ourselves took up our capex expectations for global AI capex to $820 billion for this year. That's almost a 70% year-over-year increase. And next year, we think that it gets to $1 trillion. But I think across, and the way we think about it in our AI transformation and innovation opportunities portfolio, is that you have to be exposure across the stack. Right now, we're particularly focused on where the bottlenecks are. Where are they? They're beyond memory now. They're in CPUs as well. They're in packaging. They're in substrate. And so we want to have exposure across the entire AI value chain. And we don't think that it's like a late 90s sort of situation because the demand is very strong. And look at the backlogs, right? You know, you have backlogs that are now $2 trillion. That's up significantly from $700 billion last year. So that gives you some revenue visibility as well.
If you're investing in these names with this backdrop, how much do you care about what the jobs number is in about 24 minutes time?
I care less about it, but of course it's still important to watch, not necessarily the top line payroll numbers, but I think what we all are watching is on the wage side, because that has implication for how sort of the Fed is seeing in inflation and monetary policy. And when we do end up in a situation where the Fed pivots from an ease into hiking, we don't think that that's going to be a case. We still are in the camp that we think that the Fed is going to cut, but maybe those cut gets delayed. So our focus is more on the inflation side because, you know, it doesn't feel like the job market is really cracking.
This is kind of perverse, and I don't mean to suggest that I hope this happens, but if we get a bad print, is that better for hyperscaler stocks, for some of the tech trade, given the fact that it will encourage the Fed to maintain their easing bias and allow some of the financial assets to do better?
So financial condition is, you know, obviously has tightened over the last month or so. And so that could help on the margin. But at the end of the day, you still want signs that the economy remains resilient, because that if there's cracks in the labor market, so the fact that you have a significantly negative payroll, that will cause concerns around whether we're in a soft landing situation pivoted into a hard landing. And that's not good for risk assets. And there will be a knee-jerk reaction. Now, could it eventually be a positive for sort of the spenders in tech and AI in terms of like growth is harder to come by? Yes. But in the short term, you could see a negative risk-off environment.
Nadia, is the conflict in Iran no longer a risk for equities? Is it just over?
I wouldn't say it's over. It's just it's becoming noise in the background again. I mean, I think what's been surprising to the market is that you're not seeing all of those flows through from higher energy prices. And the fact is that despite the fact that you've seen a move up in Brent, it's not $150. And, you know, of course, there's a lot of speculation of what's happening in terms of the supply potentially China put in barrels on the market. But I think it's something to watch. But the earnings story is so strong that it overpowers all of these other issues that are going on in Iran. And it's one day negotiations happen, and the next day it's not. It's just very difficult for the market to predict, so it's not an issue as much anymore.
But Jonathan has been mentioning, and Lisa, about things like Shake Shack. Some of these companies are coming out and saying that consumers actually are struggling.
Which consumer, though, right? This is very much a K-shaped economy. And I will say that K-shape has gotten worse. The higher income spenders still spending quite robust. You point to Shake Shack, but I'll point to like a Costco, mid-single digit comps, right? Yeah. I will point to a Lifetime Fitness that is saying that those income $150 are still spending. So remember, at the end of the day, the higher income consumer, 20% top quartile, is 40% of the spending. But that's not to say that the lower income isn't suffering. As you said, Shake Shack, we heard the same thing from McDonald's. You know, comps in April turned negative. So something that's worth watching. I think if you have exposure to companies that have exposure to those lower income cohort, that's where you have to be more careful. But overall, the consumer isn't collapsing.
Nadia,
it's just more dispersion.
Nailed it. It's good to see you. Appreciate it, as always. Nadia Lovell there of UBS Global Wealth Management. To Nadia's point, perfectly put, by the way, and we've been talking about this through this morning, the headline numbers capture resilience. The corporate figures, particularly in the consumer-facing part of this economy, that captures the disparity that Nadia's talking about.
And you hear it directly from companies, with McDonald's coming out and talking about some of their higher margin units, whether it's drinks or whether it's the Archburger doing better, but that the appetite from lower income consumers seems to be waning. I will just say also, there's a lot of heavy lifting here being done by some of the corporate executives in terms of messaging. I mean, with Planet Fitness, they were very controversial for a lunk alarm policy, which is no grunting when you're doing weights. Like, there are all sorts of issues that have come out.
I'm pleased you've been tracking that story closely. It's funny you bring up the Archburger. No one would have been talking about that burger unless we hadn't seen that video.
I mean, that's true.
Right.
With the CEO and taking this really small bite and being like, and then
Right.
he came under a lot of criticism.
Yes.
So maybe it was good publicity. No publicity is bad publicity.
There you
right?
go. Nadia, it's always good to see you. Thanks for being here. Always here on a Payrolls Friday. Let's get you an update on news elsewhere this morning with your Bloomberg brief. Yahara has more. Hey, Yahara.
Hi, John. Blue Owl is preparing to launch a debut credit secondary strategy, sources telling us here at Bloomberg. The company is in early stage talks with prospective investors for the fund. The volume of secondaries transactions nearly doubled last year to $20 billion. DeepSeek is ramping up its funding push. The information reporting the AI startup looking to raise as much as 50 billion yuan, and its founder could personally invest up to 20 billion. The move comes as the company speeds up efforts to generate revenue and fast-track new AI models. And hear this, FIFA is tripling the prices of its best available tickets to the World Cup final. Front category 1 tickets for its July 19th match at MetLife now cost nearly $33,000. That's almost triple what it previously cost. That's your Bloomberg brief. John?
Yahara, thank you. Thank you very much. It was so predictable, wasn't it, that this would just become the US Open on steroids?
Yeah.
This is what was always going to happen.
The issue is, whose fault is it? Is it the US's or is it FIFA's? FIFA adapted some sort of dynamic pricing that allowed prices to go to the moon. And then they had this whole resale policy where essentially they would take 15% no matter what. Is this FIFA? Is this the US? Or is it just a mismatch in terms of desires?
I still hope this turns out well. I hope in a month's time we're all celebrating this and everyone's super engaged in the sport. Obvious bias here. I want this sport to grow in this country. And that's why I'm so disappointed by the approach of FIFA right now, because it just feels like they've squandered that opportunity to grow this sport in the world's largest economy.
My kids will not be going to a game for $4,000 a ticket for nosebleed seats. Period, full stop.
That's the miss.
Yeah, and that's the issue.
Who's paying for that? It's ridiculous.
That's the miss. They should have been heavily discounted. There should have been allocations going across school after school after school to all of these host cities. And I don't feel like we've seen any of that at all.
It's a business model that seems to be good for a country with endless money, not necessarily one that has a limited budget and, frankly, a more democratic process.
Well, Andrew Giuliani, who's like the head of this for the administration, said this: we don't really believe in price controls. So just don't want to step in and say something.
So I understand that. I get that, but this is sport. Right, and this is the World Cup. This is not individual private teams, franchises trying to make money off fans. This is something that's meant to be bigger than that. I'd also say this as well. I think it was Connor Sen out on X, and forgive me if I'm getting it wrong, who said this. Said something like, traditionally we'd be talking about a host country hosting the World Cup. It just feels like FIFA's hosting the World Cup in America, not America hosting the World Cup.
It's a bad look when you have the leaders of different states coming out, like Mickey Sherrill, for example, of New Jersey, and justifying why you have to charge $100 for a ticket,
right,
because ultimately they're just not getting paid and you're not compensating us for the costs for our security.
Again, when we're covering this in a month, I hope we're having a very different conversation to the one we're having now, but the one we're having now, not good. Up next, the Morning Calls plus Mike Collins of PGIM on the growing divide inside the Federal Reserve. From New York City this morning, good morning.
The data doesn't support the narrative that's out there. We got to just do a little bit digging and say, does the narrative actually get supported by the data? I think the data is a bit more resilient than people would expect, especially on the labor front.
We get more data in just a moment from the labour market in about 13 minutes' time. That was Chris Verrone of Strategas. Equity futures right now in the S&P positive by 0.5, up by 0.7 on the Nasdaq, up by 0.5 on the Russell. That's the price action. Here are your morning calls. First up, Wedbush raising its price target on Apple to a street high 400. The firm saying the iPhone maker is the, quote, sleeping tech giant about to see a major inflection point. Stock is up this morning by 1.3%. Your next call from Wells Fargo, downgrading Nike to equal weight, citing the broader shift away from athletic apparel, creating fundamental challenges for Nike. The stock is down by 1%. You see the Adidas commercial for the World Cup?
I haven't yet.
Crushed it.
Really?
Fantastic. Just
I'll
like
watch it.
laying the boot into Nike right now.
Well, I can
What's
see.
their down?
I mean, right now, that's what they're all doing.
They've got to turn it around and fast. Finally, Stifel upgrading Shake Shack to buy, saying it offers a, quote, compelling entry point for a culturally relevant brand. That stock today is high by about 1.5%. Bramo, now YouTube in the commercial from
100%.
Adidas.
Yeah, I'll be.
Chanel's in it.
Yeah. I'll be out of commission for the next.
You get into that.
Thanks.
Okay. Let's turn to the economy. April payroll's just around the corner. The Fed facing a growing internal divide, with some officials now more focused on the other side of the mandate. Mike Collins of PGIM writing, we expect a stalemate at the Fed with increasing dissension in the ranks. Mike Collins joins us now for more. Mike, good morning, buddy. It's good to see you. Lisa's been asking this question throughout the whole of this morning at 8:30 when that number drops. Just how relevant is it to the Federal Reserve, to this market?
Yeah, I think the jobs number seems to be taking a back seat right now, right, to the stock market and to the war in Iran, of course, and to this, looming dissension at the Fed, right? As you've noted, they've become increasingly split in terms of the dovish and hawkish camps, and it feels like the hawks are sending a signal that they're trying to dig in a little bit and will push back against rate cuts, especially in this environment, right, where, as we've seen, the data just continue to be resilient. I mean, we'll find out in a few minutes what the labor market looks like, but certainly in the last, 6 months or so, it looks like the labor market has not only stabilized, but maybe has started to improve again, right? And obviously inflation remains sticky and arguably even rising a little bit in some areas. So, man, getting a rate cut in is going to be really tricky business this year.
More fuel for the hawks. Mike, the question then is why retain the easing bias? What's the argument for that?
Yeah, that it didn't surprise me, Jonathan, that you had a few members push back on the easing bias. And I think the thought is, and this is something I actually do agree with, that over the long term, I do think that neutral rate will probably be lower, or the Fed funds rate will be lower on average than it is today. It might be 3, it might be 2.5. I really believe that is probably the path we're going to get to find at some point, that we need to get there to really sustain the growth in the economy, to sustain our ability as a government and as companies and consumers to service all of this debt, right? I think these high interest rates are ultimately going to weigh on growth, whether it comes from the public or private sectors or these increasingly stressed consumers. But so I think that's really the point behind the easing bias. Say, hey, I know we're at 3 5/8. It feels like a good place now, but ultimately this funds rate will probably be lower, and that's the message. It's a long-term message I think they're signaling.
How much does the AI story complicate that, Michael? We're looking, for example, at AI spending independent of any kind of high interest rate environment that some people might suggest. There doesn't seem to be a great degree of pushback from credit investors to finance some of this build out. It's also helping to fuel inflation. At what point does that shift the narrative in a more meaningful way longer term?
Yeah, I mean, the challenge here is that, it's really a story of, two economies here, Lisa, right? Like these high rates, and I'm calling them high, are good for, or acceptable for wealthy companies that are doing well. You see earnings are great for higher end consumers. They're not an issue, right? People who own fixed income are really benefiting from this environment. But, the lower end consumers who are paying these high rates, whether it's mortgages or credit cards or auto loans, and some of these more levered companies are really going to struggle here. So, the Fed is like, what problem are they trying to solve? Are they trying to save the high end people, or are they trying to save everybody else, right? And that's part of the dissension at the Fed is you have these two camps. Like, what is our goal here, really? What part of the labor market, what part of the economy are we really trying to support here? And the AI story, Lisa, you could argue, and I know Walsh will definitely and has made this argument, that this productivity mini boom we seem to be going through, and maybe just beginning to go through, will ultimately cause, lower costs for labor, and will ultimately be disinflationary, right, is certainly the economic argument there. So maybe that opens a window for a Walsh-led Fed to cut rates over the next few years.
Mike, it sounds like you're bullish long bonds. Is that correct?
Yeah, I like bonds, Lisa. I think bonds are cheap. I think they're attractive. I think anytime that 10-year kind of gets near 4.5, it's met with resistance, right? You get buyers from all over the world step in when that long bond gets to 5. You get buyers. The curve is still pretty steep. I mean, the funds rate at 3 5/8 and a long bond at 5 is a lot of value embedded in that yield curve. And I do push back on the argument that, oh, if the Fed cuts, the curve will steepen like mad. If the curve steepens much more, that roll down effect that you're familiar with that you get in bonds becomes a powerful tailwind for future returns in fixed income. So I like rates. We've kind of been nibbling and adding duration around the globe at these levels.
Where else around the globe?
If you look at global interest rates, they've shot up everywhere. I mean, places like the UK and Japan, they have, higher yields or bigger increases in yields than we've had in the US, So, I mean, there are pockets around the world, around the global bond market, especially out on the curve, and to take advantage of these increasingly steep curves with this roll down to really add value in global bond portfolios.
Mike, when it comes to the Fed, Lisa made a point earlier. The Fed just looked through any sort of tariff impact last year. Couldn't they look through what is going on when it comes to the conflict in Iran and the increase in energy prices?
Well, they seem to be. They actually seem to be one of the central banks that's probably looking through the most, right? Other central banks generally, both in developed and emerging markets, have kind of started to tilt a little more hawkish here, given the increase in energy prices and in general inflation. The Fed actually seems one that's more stalwart, right? As you said, they've actually maintained an easing bias in the face of these rising energy prices and inflation. So they are looking through it, right? And maybe that's the right thing. We actually went back, Annmarie, and did a study of the last, 5-6 decades of oil price shocks. And in almost every case, a year after the shock, inflation is actually lower, and the Fed funds rate in most cases was lower a year later, right? And maybe that's the path we end up going down.
And Mike, you're going to stick with us. We'll talk about serious stuff like payrolls in 5 minutes' time. I also believe that your HQ is about 15 minutes away from the MetLife Stadium, Mike. We're just wondering, World Cup tickets, did PGIM get some?
I'm focused on my New York Knicks right now, Jonathan.
Yes.
That's where my head is.
Well done.
I don't think he's alone, by the way.
Everyone's
we spoke to
right now.
the president of Merrill yesterday, and he went to the Knicks game. And what did he say? He said it felt like the World Cup was coming at him. Something like that. I think they were his words.
And tonight, the Knicks are going to play the Sixers, and I imagine there's going to be more Knicks fans.
This is game 3.
Yes, there's going to be more Knicks fans in Philadelphia than probably Philadelphia tickets. Philadelphia.
Have you checked the prices?
The prices are not that bad. It's cheaper to get on an Amtrak and go watch the game in Philadelphia than to get them in New York.
Okay. Up next on the programme, we'll talk payrolls. The April payrolls report is set to cross. Mike McKee's going to break it down. We'll get reaction from Mike Collins. Plus, Francis Donald of RBC joins us from New York City with futures positive up by 0.5. This is Bloomberg. The jobs report just seconds away. The scores into it look like this. Up by 0.5 on the S&P 500, higher by 0.75% on the Nasdaq. The jobs guess, the median estimate in our survey, 65K. The previous number, 178. In the bond market, 2s, 10s, 30s. Yield shaping up as follows. 2s at 390. 10s at 437. With your jobs report, Mike McKee on the West Coast today. Mike McKee has more. Good morning, Mike.
Good morning, John. Just waiting for the numbers to drop, and here they come. The most important number of all to the markets is the unemployment rate and to the Fed, 4.3%, no change from last month. And so this report is probably not going to make a lot of waves at 20th and C Street in Washington. Terms of payrolls, 115,000, which is better than expected, but down from a revised up 185 in the month of March. The 2-month net revision, though, negative 16,000, so we lost some in February. Change in private payrolls, 123,000. That's from a 190,000 revised number for the last month. And then average hourly earnings, 0.2%, which is a little less than thought, 3.6% for the annual rate there. Labor force participation rate drops to 61.8 from 61.9%, which suggests something about the unemployment rate. So I'll take a look at the breakdown of the various categories while you take a look at whether the markets are even paying attention today.
Mike, thank you, buddy. I'll run through things and we'll start with equities. Equity futures positive near session highs, up by 0.6, up by 0.75% on the Russell. The small caps with some slight outperformance relative to the S&P. Tech still doing OK, up by 0.8%. In the bond market right now, 2s, 10s, 30s, just erasing some of the move from earlier on this morning. Not a big move, holding on to 390 on 2s right now. I'll mention crude because it's part of the conversation. Triple digits on Brent, 100 rather. Woof. Not 300. WTI right now at 95, positive by about 1/10 or 0.2%. That is a good jobs number. Private payrolls is better than good. And if you look at this number from the perspective of risk assets and financial markets investors worldwide right now, you've got good job numbers, fantastic at the headline, unemployment just about anchored, wages haven't run away. So from the perspective of the Federal Reserve, you're not going to sit here and think they're going to be hiking anytime soon. Probably won't be cutting, but won't be hiking.
Yeah, there really isn't the inflationary pressure. The idea that average hourly earnings actually came in below expectations in terms of the increase, and that you did see average hours worked come in pretty much in line, about the same, just up a little bit, gives you a sense that there is stability when it comes to the price pressures and the wage increases, the key component of a wage price spiral that you need to really change in a meaningful way. So yes, this is a labor market that is solid, good enough to hold up some of the economic optimism, but not running away in terms of some of the inflationary expectations.
The details matter. Mike McKee has more. Mike, what do you see?
Well, John, as always, healthcare leads the pack with 37,000 jobs created. That's a little higher than the 12-month average of about 32,000. That is where jobs are these days. Transportation and warehousing increased by 30,000. We've certainly seen a lot of increase in people buying on the internet, et cetera. So that's an interesting development there if that keeps going up. Retail, 22,000, partially offset by job losses in department stores, down 7,000. Federal government, the administration's effort to pare things back has continued. Federal government employment declined by 9,000 in April. And since October 2024, the federal government employment down by 348,000 or 11.5%. So we are seeing the Doge stuff work out. In terms of what Lisa was saying, I was talking to a lot of Fed people here at the Hoover conference last night, and they are keeping an eye on the average hourly earnings because they want to make sure that the inflation that we're seeing isn't feeding into people's psychology where they're going and asking or demanding raises at this point, especially with the labor market loose right now. It is a relatively good situation for employers. They don't have to pay up. The question happens when AI takes over and people lose jobs, what happens to incomes then? But the Fed is going to look at this whole report and say it's not inflationary, and it is, as Lisa said, very stable.
Mike McKee, thank you, sir. The perfect kind of report. The financial markets, in many ways, equity futures positive by 0.6.
Maybe not if you work in financial services, though.
Of course.
If you take a look at the actual breakdown, the financial industry saw a negative 11,000 jobs that were lost. That follows 19,000 jobs that were lost in the prior reading. You also see a negative read for information. You also see a negative read for some other aspects that could be more tied to some of the artificial intelligence-related productivity gains. Where do you see the gains? In the physical things that you have to do, like healthcare and goods-producing aspects, construction, as well as leisure. So interesting to see how this is shaking out.
We can spend some time beneath the surface, but on a headline view, 115 payrolls, upside surprise off the back of a really strong number the month before. I don't think we've established a trend yet, but there is a hope we're starting to see a cyclical bounce here. And I wonder if we'll see more of the same through the summer.
It seems as though, and especially based on what we were hearing from Neela Richardson of ADP, smaller businesses, the healthcare sector, other areas are starting to pick up. What are the conditions required to sustain that momentum is a key question. At what point will the higher producer prices start to bite more materially?
Francis Donald of RBC joins us now for more. Francis, welcome to the programme. 115, the estimate 65 is an upside surprise. Beneath the surface, how encouraging are things?
Well, John, you've heard me say it before. America needs workers, not jobs, and that is so clear in today's April release. Job creation is just fine in America. It is matching what we're seeing in low jobless claims, improving continuous claims, drops in layoffs activity. We have more than enough jobs to actually lower the rate of unemployment over time. We are substantially above that break-even rate. And for a long time, for the last decade, that's what would have mattered most. Is the consumer employed? But that's not what matters in the American economy anymore. What matters is not do they have a job, it's are they working enough hours, a little bit better in April, and are they making enough money in those jobs? Now, wage growth, a little disappointing here, and I'm watching this very, very closely as we head into an inflationary shock. Real wages are very close to zero and could go negative. So the story here is one of cyclical improvement, but also a lot of structural themes coming through in this morning's number.
So, Francis, on the structural themes, you'd expect wages to be hotter than they are. When I hear you say we're lacking workers, not jobs, that sounds like a labour market that should be tight, generating wage growth. So what's going wrong there?
Well, it's not going wrong. You've got wage growth of 3.6% and moving higher. And again, it's a structural theme that will evolve over time. There's also a sectoral issue here. I'm seeing almost half of this job growth is once again in healthcare and education. In the past year, if you take out healthcare and education from the system, cyclical private payrolls are going negative. So we hear a lot about this no hire, no fire zone. That's true on aggregate, but it's not true by sector. There's plenty of hiring in education and plenty of firing in trade-related sectors. So just looking at that aggregate and saying, well, this is true for everybody isn't quite the case. And I'll highlight here, once again, my eye went right through it. Labor force participation rate is down again. This peaked in 2001, John, has been declining ever since and is getting worse, not better. So a little bit of wage growth is here, but this is going to be the issue going forward in the next 1 to 3 years in America is can you find the right workers? Can you find the right skilled workers? And what do you have to pay to get them?
Francis, how much were you watching in real time the shift from white collar to other jobs, whether it's in manufacturing and construction or whether it's in education and healthcare?
We talk to clients about this endlessly because what we highlight to them is as a growing share of jobs are public sector or public sector adjacent, the cyclicality of your job market starts to decline. For example, we don't see cyclicality in healthcare employment. If there's a recession, you don't really see a meaningful decline. And that sort of breaks the relationship between private sector cyclical weakness and the job market. It also means it's less likely to spread through the whole economy than it has before. Now, the downside of that is that you don't tend to see the same sort of large productivity increases. You don't see the same 4, 5, 6% GDP numbers that you start to see if big private sector engagement. So effectively what this means is as the job market moves towards more government and government adjacent type roles, you end up with a floor undergrowth, but also a ceiling. And that's the key takeaway from these big structural trends is the way that we've looked at these numbers. Been on this show for a decade. I've talked about a lot of them. It's going to have to change.
Francis, how much does this underscore the difficult decision that the Federal Reserve has to make? Because ultimately they don't influence the jobs that you're talking about that much one way or another. They do, however, potentially influence financial conditions that are leading to some of the optimism in areas like artificial intelligence.
You know, I don't know why it would be a difficult decision, although clearly there's some angst in the Federal Reserve. Where is the data that would suggest that easing is necessary? What problem are we trying to solve? There's job creation, a very tight labor market. Underlying trends of inflation are heading upwards, not downwards. There's still a significant amount of heat under this economy. And the risk now, particularly in the last month of seeing a lot of underlying labor market indicators picking up, is not of disinflation or needing to ease to correct for some growth downturn, but actually having to be very cognizant of the upside risks, no longer just for inflation, but for the economy as well. And, you know, every month we put out a report and we say, what's the risk to our base case? The risk to our base case for growth is now tilted upwards. And that's really disjointed from the ongoing narrative that there's weakness in the job market and that there could be recession concerns coming. We just don't see it.
Hey, Francis, always good to catch up. Francis Donald there of RBC following the jobs report. It's not an argument for a rate hike right now, but it's certainly not an argument for holding an easing bias to the Federal Reserve either.
This is a solid labor market, and you can see that. It might not be the kind of labor growth that indicates some sort of cyclical upturn that some people would like. Nonetheless, it is solid. If you want a job, for the most part, if you're willing to be flexible about where you go to look for it, you can find one. That said, is this a Fed that is looking for a broader-based participation in some of the other sectors, too? And will Fed rates do anything about that? Will that cause some of these sectors to increase jobs, or is this a structural shift underpinning this economy?
I should clarify my comments on wages. What I mean is we're not seeing an upside surprise on wages relative to gains you would expect to see that would generate that kind of upside surprise. 0.2 month over month. The estimate was 0.3.
Yeah, and this is the reason why, on one hand, you could say this isn't going to lead to inflationary pressures. If you were still a dove on the Federal Reserve, you could point to this and say, actually, as Francis Donna was talking about, you're not getting actual real wages increasing. In fact, they are going to go negative, given the fact that inflation is surpassing that in certain consumer goods. So that could lead to disinflation, possibly what the likes of McDonald's and Shake Shack are seeing.
Mike Collins at PGIM, still with us. Mike, you've been going through the numbers, the results. What was your first reaction when you saw that 115?
Yeah, this just kind of, this locks in the stalemate at the Fed, right? It really kind of solidifies the fact that they are on hold here indefinitely. But as Lisa, as you pointed out, there are some whiffs of both the AI productivity story and wage disinflation in these data, right? I mean, Francis said, we've seen kind of real wages start to go back up. And I don't see that. I mean, since they peaked in COVID, wage growth has been in a disinflationary trend, and that trend continues today, right? So maybe it's a shift in the labor mix from higher paying white collar tech and investment jobs, to healthcare and education. But you are seeing disinflation on the wage story. So as a whole, this labor market picture is not an inflation. It's not adding to the inflationary story. It's the other things like energy and supply shortages that are causing the inflation. And those are things actually that the Fed can't control, right? They can control the demand side, not the supply side. So, if anything, maybe this is just more fuel to the fire for, someone like Warsh who can, say, wow, look, you're seeing the productivity come through. You're not seeing wage pressures at all. Maybe ultimately he can sway a couple other members to cut rates, in a year from now.
Mike, with that in mind, as you look across the curve, 2s, 10s, 30s, given everything you've said this morning, you've said you're bullish bonds, I imagine you still are. This number's not going to change that, of course. It might encourage it. Where's the opportunity across the curve right now?
It's really in that belly, and to get inside the yield curve here, like that 5 to 10 year part is where we're long. The 20-year looks cheap. Basically, 5 to 20 year part of the curve is where we're overweight. That's the steeper part of the curve that's upward sloping, and there looks like there's a lot of value there.
Mike Collins, good to see you. Mike, thanks for making time for us. We appreciate it. Mike Collins there of PGIM. If you're just joining us, a solid 115 on payrolls. Upside surprise. The estimate 65k. Wages a bit softer than expected month over month, and unemployment so far pretty stable.
We can't overstate, we can't really emphasize enough how much this is an economy in transition on multiple fronts. And these numbers have very different meaning when you dig under the surface and you understand that this is a shift to jobs that previously were largely taken also by immigrants and people taking over those jobs, and other areas seeing more AI disruption. A really interesting moment.
Things can change. The first move isn't always the right move. We play that game every single first Friday of any given month when we get the payrolls report. But right now, session highs, a bullish take on this jobs market, 0.6% higher on the S&P 500. With an update on stories worldwide with your Bloomberg Brief, Yahira has more. Hey, Yahira.
Hi, John. Recapping the jobs report, non-farm payrolls coming in well above estimates for April, with 115,000 jobs added in the month versus estimates for 65,000. It marks the first back-to-back advance in nearly a year. The unemployment rate holding steady at 4.3%. A federal trade court declaring President Trump's 10% global tariffs unlawful. The panel granting a request by a group of small businesses and some states to vacate the levies. The move coming months after the Supreme Court struck down Trump's other tariffs done under emergency powers. And the U.S. awaiting a response from Iran on its peace deal proposal. Secretary of State Marco Rubio says he's confident the response is coming soon.
We're expecting a response from them today at some point. We have not received that yet, as in the last hour, but perhaps that will come. Their system is still highly fractured and a bit dysfunctional as well. So that may be serving as an impediment. I hope it's a serious offer. I really do.
And yet Iran's foreign minister writing on social media this morning, quotes, Iranians never bow to pressure. That's your Bloomberg Brief. John.
Yahara, thank you. Thanks for this morning. Up next, Jeff Rosenberg of Blackrock breaking down the latest jobs report. Plus, Danny has your morning movers. CoreWeave sinking on a disappointing outlook. That name is down by 7% in the pre-market.
Needs workers, not jobs. And that is so clear in today's April release. Job creation is just fine in America. It is matching what we're seeing in low jobless claims, improving continuous claims, drops in layoffs activity. We have more than enough jobs to actually lower the rate of unemployment over time.
Francis Donald, RBC, on this jobs report. Upside surprise on payrolls. Equities just off session highs, up by 0.6% on the S&P 500. On the Nasdaq, up by 0.9. The cash open about 40 minutes away. With your morning movers, here's Danny Berger. Hey, Danny.
Hey, Don. It's been a rough morning for what this cycle has been the poster child for fears over AI spending, and that is CoreWeave. First quarter, that beats, but their second quarter outlook disappoints. That's particularly a problem because in their estimate for how much they're going to spend on CapEx was raised. At the low end, they now see as much as $31 billion. That's a $1 billion increase. They hold the top end of their range, which would be $35 billion for the year. So those shares falling just about 6.7%. Elsewhere this morning, Block reporting earnings, seeing a sunnier outlook, saying that all those job cuts, that was 40% that they announced, while painful, were necessary and are paying off. They say you'll start to see that pay dividends in the second quarter. So shares are up 9.5%. Finally, the last round of earnings coming from Monster. A good set of results. Shares up 8.3%. JPMorgan upgrades their price target for the company. Our analysts at Bloomberg note that it's been a really strong market for all energy drinks. Annmarie Celsius, for example, reported earnings yesterday. Those were also strong. So this market for energy drinks, really strong, John.
Danny, thank you. Is this morning a Celsius morning?
No,
it's not.
Really
okay.
Once in a while.
It's after a party night. Is that right?
Yeah, which is like twice a year.
Twice a year. Okay. Danny, thank you. Looking forward to the program with Danny in about 40 minutes' time. She'll be catching up with the NEC director, Kevin Hassett, so look out for that. The view from the White House just around the corner. Stocks trading very close to all-time highs when we open up in about 40 minutes' time. The April payrolls report showing the first back-to-back monthly gains in nearly a year. Jeffrey Rosenberg of Blackrock joins us now for more. Jeff, your first take on that jobs report.
Yeah, it's really this trade-off between the headline strong, better than expected payroll number and a little bit weaker on the income side. I think that trade-off is kind of pushing the market reaction, kind of first reaction, a little bit more towards the disinflation side. But this is all very much, Jonathan, on the margin. But I think that's the take from the payroll report. Not a huge change in terms of the information. I think it's steady as it goes. I think Mike Collins at PGIM said it well, like this kind of maintains the status quo. And, the market's kind of pricing that in terms of the expectations for the Fed. So I don't think this really changes that story. But if anything, there's a story coming out. It's a little bit on the margin, the weakness on the income side.
Do you think going forward on the margins that payrolls report is going to be less and less relevant to risk appetite going forward, as we seem to be seeing this morning?
Yeah, well, it's just because what is the dominant theme that is driving all things in these markets? Whether you're a macro player or a micro player, the story isn't really so much traditional macroeconomics. Macroeconomics have been taken over by the AI theme, right? So when we look at the GDP statistics, when we look at spending, it's less about the consumption that's moving and much more about the capital expenditures. And we know that story is much more about AI. And then when you look at financial markets, it's really much more about the impact of AI. So, payrolls, they're important. They're a big summary measure, but there's a lot of dispersion going on. And you guys talked about it in the early segments. What you see a lot more in the payroll reports is that education and that healthcare space. Yes, that's an impact, But what we're seeing in financial markets, both macro and micro, it's just much more about this AI theme.
Jeff, do you agree with Kevin Warsh that AI is more disinflationary than it is inflationary?
Well, there's a long history here of technology being disinflationary. And most of that has been on the good side. Now what we're seeing, and this is the huge debate, right, is this technology is really about the services. Now, first, it's not hitting that directly because it's about the physical infrastructure, whether we're talking about chips or data centers or energy, but it's all coming to the service side of the economy. And this is the big uncertainty about what impact does that have. It raises productivity. That's ultimately good. That's ultimately good for wages. But the transition effects are unknown. How quickly does it happen? What's the impact in terms of jobs, and do you do more with what you have, or do you do the same with a lot less? And that impact can have a much shorter run impact in terms of wages and wage inflation, which is where we may see that AI impact first.
The sequencing could be really messy. Jeff, appreciate your time today, buddy. Thank you as always. Jeff Rosenberg there of BlackRock, following a really decent jobs report. The next stop for this market is Iran and their response to the proposal made by the US earlier on this week. The Secretary, Mr. Rubio, mentioned a little bit earlier on in a briefing that we should be getting that response later on today.
Does it continue to de-escalate? Does this also continue to lead us toward a sense that we are heading toward a resolution? I'm just thinking, if you've got inflationary pressures coming from energy costs, which are probably going to remain higher, you have inflationary pressures coming from the build-out of AI, and you have disinflationary pressures coming from people's wages if they're not keeping up with the level of inflation. Is that a good thing? Is that a bad thing? Is that inflationary? Or is that just something that is problematic, at least for the humans? What?
The less you know.
I mean, this is, okay, yeah, I'm going to go back into that place of oblivion.
To John's point and your point earlier about the fact that it has been such a fractured regime, that's what Secretary of State Marco Rubio was talking about. The system is highly fractured and a bit dysfunctional, so that might be serving as an impediment on why it's taking them so long to respond. It also might mean they're not sure exactly how to respond, because our own CIA intelligence, according to the Washington Post, says they could withstand this blockade for another 3-4 months. That's the entire summer for the United States going into the midterm elections.
Coming up on Monday, the conversation continues. Sarah Hunt of Alpine Saxon Woods, Norman Rule of CSIS, Matt Hornbeck of Morgan Stanley, James Steele of HSBC. From New York City, thank you for choosing Bloomberg TV. To all the mums who make the world go round, have a wonderful Mother's Day. This was Bloomberg Surveillance.